Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, what if I told you that one of the most successful investors of the last 50 years made his name by doing the one thing most people are absolutely terrified to do, and that's swimming directly against the tide? Today, we're cracking open the playbook of a living legend, Anthony Bolton. We're going to see how he turned a deeply contrarian view into just, well, historic returns. Now, you might think a guy like this came from a long line of financiers, right? Nope. Anthony Bolton actually started out as a Cambridge-educated engineer, and that analytical, problem-solving brain, when he brought it to the City of London back in 1979, it gave him this totally unique perspective that would make him one of Fidelity's most celebrated managers for the next 28 years. And look, that's not just a clever title for his book, it's the master key to his entire philosophy, being a contrarian. It really comes down to having the guts to be skeptical when everyone else is popping champagne and having the discipline to hunt for opportunities when the rest of the world is panicking. So, how in the world did he actually do it? Well, we've broken his whole playbook down into 5 core principles. We're going to start with that contrarian mindset, then we'll dive into his detective-like research, how he mastered market psychology, his strategy for building a tough portfolio, and finally, the mindset that really holds it all together. So what does it really mean to be a contrarian? For Bolton, it's not about being different just for the heck of it. No, it's a disciplined hunt for value in the places that other people are just too scared to even look. It's about finding those hidden gems in the market's bargain bin, while everyone else is chasing the same shiny, overpriced, popular new thing. You know, Bolton's whole approach really echoes this timeless wisdom from John Maynard Keynes, and it boils down to something so simple yet so powerful. By the time an investment is popular and everyone agrees it's a sure thing, the biggest profits are already gone. The real money, the kind of returns that can change your life, are made by finding value before the crowd even knows where to look. And this is where that contrarian edge becomes so clear. Think about it. At the very peaks and troughs of the market, when greed and fear are at their absolute max, the crowd is almost always wrong. The story for buying a stock is never more compelling than at the absolute top. Bolton knew that real opportunity, and frankly, a much bigger margin of safety, lies with the unloved, the under-owned stocks that the market has just completely given up on. But here's the thing. Being a contrarian without doing the work, well, that's just a recipe for disaster. Bolton's conviction wasn't some vague gut feeling. It was built on a foundation of intense, almost forensic research. He wasn't just picking stocks, he was a true business detective, and this is how he found his clues. This is the one question that drove every single one of his investment decisions. It was never about the ticker symbol on the screen. It was always about the living, breathing business behind it. He would constantly ask himself, is this a great business? Does it have a real sustainable advantage? And most importantly, is it going to be worth more in 10 years than it is today? I mean, just look at the sheer amount of homework Bolton did before he would even think about taking a meeting with a CEO. He'd pore over years of stock charts, its valuation cycles. He'd check who was buying and selling from inside the company and who the other major owners were. He'd even assess the company's financial strength using tools like the H-score, which is basically a model that predicts the odds of bankruptcy. He was building a complete dossier on a company before ever shaking a hand. And you know, beyond all the spreadsheets, he was looking for these timeless qualities. He wanted businesses with a protective moat, a strong, durable, competitive edge. He needed to be able to understand the business model easily. Crucially, it had to be a cash-generating machine, not a cash furnace that just burns their capital. And it had to be run by honest managers who had their own money on the line, making sure their interests were perfectly aligned with his. Okay, so you can be the best business analyst in the world. You can pick the best company on the planet. But you can still lose a fortune if you don't understand the wild, emotional beast that is the stock market. For Bolton, this meant mastering not only the market psychology, but his own. He was a huge believer in this classic analogy from Ben Graham. In the short term, the market's just a chaotic popularity contest, a voting machine driven by whims and rumors. But over the long haul, the fundamentals always win out, and the market becomes a weighing machine, accurately assessing what a company is truly worth. The contrarian's job is to completely ignore the daily polls and focus only on that final weigh-in. And the perfect way to picture this is through the character of Mr. Market. Think of him like this crazy business partner you have, but he's emotionally unstable. Some days he's euphoric, offering you absurdly high prices for your shares. Other days he's terrified and will sell you his for pennies on the dollar. Bolton's genius was in treating Mr. Market as a servant to be taken advantage of, never, ever as a master to be followed. So here's the bottom line, right? Your conviction has to come from your own research and your own analysis. The market agreeing or disagreeing with you, that's just noise. The price that Mr. Market is screaming at you every day is just an offer. It's your homework that tells you whether it's a bargain or a trap. So, you've got the contrarian mindset, you've done your detective work, you're ignoring Mr. Market's daily drama. So, how do you actually weave all of this together into a portfolio that not only grows, but can survive the inevitable market storms and your own mistakes? This number right here, this is a powerful dose of humility. Bolton reminds us that even the greatest investors are flat out wrong a huge amount of the time. We're talking at least 2 out of every 5 decisions. Success isn't about having a perfect batting average. It's about making sure your wins are much, much bigger than your losses, and most importantly, avoiding those catastrophic mistakes that can just wipe you out. And a huge part of avoiding those big losses is having a cold, calculated, emotion-free plan for when to sell. For Bolton, there were really only 3 logical reasons to sell. 1, the facts have changed and your original reason for buying just isn't true anymore. 2, the stock has hit its fair value and it's not a bargain anymore. Or 3, you found a much better opportunity somewhere else. Notice what's missing? Selling in a panic just because the price went down. That's letting Mr. Market win. And this insight from his colleague Peter Lynch just reinforces a core lesson for Bolton. He admitted his own biggest mistakes almost always involved companies with weak finances. Too much debt, it's like a ticking time bomb, just waiting to explode at the worst possible moment. For Bolton, winning by not losing meant steering clear of those financial minefields at all costs. And that brings us to the final, and I would argue, the most crucial piece of Bolton's success. It's not a formula you can just plug into a spreadsheet. It's about the personal qualities, the character, and the unwavering mindset you need to execute this kind of strategy day in and day out for decades. And this is what really separates the legends from everybody else. It is not about having the highest IQ. It's about temperament. That ability to stay calm when everything's on fire and to be humble enough to admit when you're wrong. It's about having the seeing eye to spot what others miss, the discipline to stick to your process when it's uncomfortable, and the deep curiosity to never, ever stop learning. We're going to leave you with this powerful thought from Peter Lynch because it perfectly captures the essence of Anthony Bolton's playbook. The ultimate test in investing, it isn't a measure of your intellect, it's a measure of your emotional fortitude. It's having the stomach to buy when there's fear in the streets, to sell when there's greed, and to hold on to your convictions when the entire world is screaming that you're wrong. The question is, do you have the stomach for it? Welcome to The Explainer. Today, we're going to pull back the curtain on how professional investors really analyze a company. Forget the hot stock tips, forget all the fleeting trends. We are going to dig into the deep, methodical work that goes into understanding a business before a single dollar ever gets invested. You know, we just have to start with this piece of timeless wisdom from Warren Buffett. It perfectly captures the goal here, finding a business that is truly, truly durable. The key isn't just finding a brilliant CEO, though, hey, that helps. It's about finding a business so fundamentally strong that it can thrive even when leadership isn't exactly perfect. So, okay, how do you find one of these foolproof businesses? Well, it all starts with understanding its competitive advantage. And Buffett's longtime partner, the brilliant Charlie Munger, he has the perfect analogy for this. He calls it a company's moat. Think about it like a medieval castle, right? A great business needs a wide, deep moat to keep all the invaders, in this case the competitors, out. Now, this moat isn't just one thing. It's a powerful combination of factors. It could be an immense brand, one that makes customers pick it without even thinking. Or maybe it's unique products protected by patents, or a distribution channel that's just impossible for anybody else to replicate. A truly enduring moat, that's what allows a superior company to protect its profits year after year after year. When I'm looking at any company, this is the first question I ask myself. It's so simple, but it's incredibly profound. And you'd be amazed how many businesses just fail this fundamental test. Yeah, they might have a great product for today's market, but is the model sustainable? Is that demand still going to exist a decade from now? If the answer isn't a really confident yes, that's a huge red flag for me. And this leads to an absolutely crucial quality: self-reliance. You see, the best businesses, they control their own destiny. They stand on their own 2 feet, and they're relatively insulated from all the economic chaos that's always swirling around. Now, they're not completely immune, of course, but their success isn't dictated by the latest interest rate hike or the whims of the currency markets. Let me give you a perfect real-world example. So an analyst is looking at a UK-based chemical company. On the surface, it looks great. Business is good, successfully exporting to Europe. But when you dig into the numbers, you find its entire profitability is at the mercy of the sterling to euro exchange rate. A 15% swing, which is not that uncommon, could completely wipe them out. Their destiny isn't in their hands, it's in the hands of Forex traders. For me, that makes it an easy pass. This brings us to a really crucial point: cash. It's the lifeblood of any business, right? A professional investor will always, always favor a business that generates cash over one that constantly consumes it just to grow. I mean, look at the left column here. That is the ideal. A service business can often grow without massive capital investments. Compare that to a heavy manufacturing company that has to build a whole new factory every time it wants to expand. Cash on cash return, that's the ultimate measure of quality. And you have to always remember this fundamental law of financial gravity: mean reversion. Capitalism is just brutally competitive. If a company is enjoying these sky-high growth rates and incredible profit margins, you can bet competitors are going to swarm in to get a piece of that action. Over time, very, very few companies can defy this pull back toward the average. And that's exactly why that deep, wide moat is so incredibly vital. Okay, so with those principles in mind, we can move to the next phase: building the dossier. Before an investor ever even thinks about speaking to a company's management, they have to do their homework. And this isn't a quick Google search. This is about creating a complete intelligence file on the business. I mean, just look at the sheer volume of research here. It's critical. This isn't about finding one magic metric. It's about putting together a complete mosaic. For example, looking at something like credit default spreads, that's basically the cost to insure the company's debt. It tells you what the often smarter bond market thinks about its financial health. Or how about this one? Are the directors buying their own stock with their own money? That's a powerful signal. Every single piece of this puzzle adds another layer of understanding before you even think about having that first conversation. Okay, so the dossier is complete. You've done hours of prep work. Now it's time for the meeting. But walking in with the right mindset, well, that's just as important as all the data you've collected. A cynical but very sharp broker once said this to me, and it has a definite ring of truth. Look, management's job is to present their company in the best possible light. They're there to make their shares seem attractive, to get you excited about the story. Your job is to see past the bright lights and the whole funfair atmosphere and really focus on the underlying mechanics of the business. So you're in the room, face to face with the CEO or the CFO. The single most important thing to remember is that you are in control. This is your time, and you must set the agenda. Don't let them just run through their standard polished presentation. This is not a casual chat. We follow a disciplined, structured approach. We go division by division, digging deep into the details: volumes, prices, costs, margins. We want to understand the strategy, the competitive pressures, and crucially, what's not working as well as what is. By the end, we should have a granular understanding of the entire P&L, the cash flow, and the balance sheet. Now, the meeting isn't just about gathering facts and figures you could find in a report. It's about uncovering the truths that lie between the lines. So the crucial skill here is learning to see through the inevitable corporate spin. Every management team has a story, and your job is to test that story. Here's a simple but incredibly effective technique. Towards the end of the meeting, an investor might just casually ask about another company in their orbit, a key competitor, or maybe a major supplier. Not all management will talk, but when they do, it can be pure gold. A positive, respectful comment about a competitor, wow, that carries enormous weight precisely because it's so unexpected. And this highlights a fundamental rule of analysis. You expect a CEO to say their business is great and their competitors are struggling. That's predictable, right? But when they say something that goes against their own self-interest, like praising a rival, that's when you should really lean in and pay attention. Unexpected honesty is far more valuable than predictable optimism. Let's look at one final, dramatic example of why all of this matters. It's about a risk that was hidden in plain sight, right there in the business model itself, the infamous case of the UK bank Northern Rock. On the surface, Northern Rock looked fine. It was growing fast, management wasn't doing anything overtly wrong, but its entire business model was built on a really risky foundation. You see, unlike traditional banks that rely on stable customer deposits, it was heavily dependent on wholesale funding, basically short-term borrowing from other banks. And in good times, that's a cheap and easy way to fund growth. But then came July 2007. The credit markets froze. Suddenly, that cheap and easy funding just disappeared overnight. Northern Rock's business model didn't just stumble, it collapsed catastrophically. The risk was always there, embedded in the very structure of the business. This is the ultimate proof of why a deep understanding of the business model is just paramount. So after all the research, all the analysis, that intense meeting, the process still isn't over. A good investor doesn't walk away with all the answers. They walk away with clarity, sure, but also with one final crucial question that they need to ponder. What's the one piece of the puzzle that still doesn't quite fit? What's the one risk that needs more thought? And that's our final thought for today. What's the one question you're still asking?
Have you ever found a company that just looks perfect on paper? I mean, the numbers are great, the product is a winner, but the investment just goes nowhere, or worse, goes south. Well, today we're going to talk about the one thing that can sink even the most beautiful-looking business: the people running the show.
You know, Warren Buffett just has a way of cutting right to the heart of the matter, doesn't he? This quote is the perfect place for us to start. It tells you that even a genius CEO can't fix a fundamentally broken business. But here's the flip side, and this is what's really important. A bad manager can absolutely wreck a fantastic business. So how do we spot the good ones from the bad?
And this right here, this is what I call the management trap. It's so easy to fall into. You see a charismatic leader, they tell a great story, you get excited, and you forget to check if they're actually any good at their job. I'm going to walk you through a professional's guide to not just avoiding this trap, but turning it to your advantage.
Okay, so here is the absolute first rule of the game. Before you look at a single balance sheet, before you calculate a single ratio, you have to analyze the people. Seriously, put the numbers aside, because if you can't trust the people in charge, none of the numbers they're giving you matter anyway.
I love this analogy from the legendary Phil Fisher. It's so true. You're not just taking a company on a first date when you invest. You're basically marrying it. You can't learn everything from one slick presentation. You need to see how these people act over time. How do they handle a crisis? Do they actually do what they said they were going to do a year ago? That's when you really find out who you're in business with. Let me tell you, this is a lesson that I've got the scars to prove. Early in my career, I got suckered in by a company that had it all, or so I thought. Great brand, dominant market position, but I just had this little nagging doubt about the CEO. Something didn't feel right. I ignored it. I thought, the business is too good to fail, and boy did I pay for that mistake. Now, if my gut even whispers that something's off, I'm out. No questions asked.
And this is exactly why that rule is non-negotiable. Management has 1,000 ways to pull the wool over your eyes, and they can keep it up for a surprisingly long time. And here's the really dangerous part. When a management team gets used to misleading the public, they eventually start to mislead themselves. They start believing their own hype, and that is always a disaster waiting to happen.
All right, so a gut feeling is a good start, but we need more than that, right? We need to build a real case. So let's open up the toolkit and see what we should be looking for.
It really boils down to these 4 things. 1. Competence. Are they actually good at what they do? 2. Character. Are they honest, decent people? 3. Alignment. Are their interests the same as your interests? And 4, the big one, candor. Are they going to tell you the truth, especially when it hurts? Let's dig into each one.
You know, real competence isn't about being slick. It's about being deep. It's when you can ask a CEO a really specific, nerdy question about some obscure part of their operations, and they light up and give you a 10-minute detailed answer without even blinking. You can tell they are absolutely fanatical about every little detail of the business. And most importantly, you look back at what they promised a year or 2 ago, and you see that they actually did it.
Now, this isn't something you can just learn overnight. It takes time. After you've sat through hundreds of meetings and earnings calls, you start to develop this antenna. You can just feel it when you're talking to someone who's genuinely world-class versus someone who's just good at talking. You start to see the patterns.
Okay, this one is huge. I want to see a management team that eats its own cooking. This means they have a serious chunk of their own personal net worth tied up in company stock. And I mean stock they bought with their own cash, not a mountain of stock options. Options are a one-way bet. They only win if the stock goes up. I want them to have real shares, so if the stock goes down, they feel the exact same pain that you and I do.
So, on to the toughest one, candor. How do you get a straight answer out of somebody who's a professional at putting a positive spin on everything? Well, it turns out it's all about how you ask the question.
This little trick is a total game changer. Don't ask a leading question like, so the new product is selling well? Of course they're going to say yes. Instead, you frame it negatively and more broadly. You say something like, I've heard from a few of your competitors that the supply chain has been a real headache lately. What sort of challenges have you guys been running into? It gives them permission to be honest, and you get a much, much more revealing answer.
So we've talked about what management says. Now let's talk about the ultimate truth detector, what they do with their own money. Forget the press releases, watch where the cash is flowing.
You have to learn how to read the signals here, because not all insider deals are created equal. You're looking for the signal, not the noise. So if a founder sells a few shares after the stock has gone up 1,000%, that's probably just noise. But if the CEO and the CFO both come in and make huge multi-million-dollar buys with their own cash, that's not just a signal, that's a foghorn.
Now pay close attention to this one. This is one of the scariest red flags you can ever see as an investor. The stock price gets hammered. It's down 30–40%. And then you see the insiders start selling heavily. What are they telling you? They're screaming, "We have no confidence this is coming back anytime soon." It's a sign that the people who know the most are heading for the exits.
And here's the flip side. Let's say a stock has had a great run. It's already up a lot. Then you see an insider step in and make a really big purchase. That is an incredibly powerful vote of confidence. They're telling you that even after this big run-up, they think there's still a lot more value to be had. They believe the good times are just getting started.
All right, so we've covered the 4 pillars. We've looked at reading the insider tea leaves. But after all that, there's one simple truth I've learned that trumps everything else. It's this simple. People don't change. A manager with a long history of overpromising and underdelivering is probably going to do it again. A leader who has a reputation for being shady, well, a leopard doesn't change its spots. Their track record, their entire career history is the single best predictor of what they're going to do in the future.
And I think this quote just sums it all up perfectly. At the end of the day, an investment is a partnership. You're entrusting these people with your hard-earned capital. It all comes back to trust. And while you don't literally need to want them as a son-in-law, it's not a bad way to think about it. Is this a person of character? Is this someone I want to be in a long-term relationship with?
So the next time you're about to buy a stock, just pause for a second. Look past the ticker symbol. Look past the quarterly earnings. Ask yourself this one simple question. Who am I really betting on? Because you're not just investing in a business. You are always investing in people. And choosing the right ones makes all the difference in the world.
All right, let's talk about investing. We've all been there, right? You're watching the stock market, you see your pick go up, and you feel like a genius. Then it goes down, and you get that sinking feeling in your stomach. It's a total emotional roller coaster. But what if I told you there's a better way? A way to trade that chaos for clarity and that emotion for discipline? Well, there is. It's all about building an investment thesis. And that is exactly what we're going to break down today.
I want to start with this quote from Warren Buffett because it's so simple, but it hits so hard. A stock doesn't know that you own it. Think about that for a second. That company you've put your money into, that you're checking on every day, it has no idea who you are. It doesn't care what price you paid. It doesn't care if you're hoping to pay for college or just make a quick buck. The stock is completely 100% indifferent to you.
So that leads to the big question, right? If the stock doesn't care about us, why do we get so incredibly emotional about it? Why do we get so attached, or so anxious, or so stubborn about needing to get our money back when a stock goes down? Well, the answer is all in our heads. It's human psychology. And learning to master that is really the secret to investing well. So here's the game plan for how we're going to do that. We'll start with what I call the golden rule of owning stocks. Then we'll get into the nitty-gritty of defining your investment thesis. After that, we'll talk about the counter thesis, which is super important. Then we'll tackle those psychological traps that get all of us. And we'll finish up by talking about why conviction is way better than price targets, and I'll give you a full framework to put it all together. Okay, first things first, the golden rule. And it is so simple, but you'd be amazed how many people ignore it. Every single stock in your portfolio needs a story. It needs a reason to exist. If you can't explain why you own it, you probably shouldn't. And that story, that reason, it all starts with a huge mental shift. Buffett said it best. You're not buying a ticker symbol. You're not buying a little blip on a screen that goes up and down. You are buying a small piece of a real-life business. The moment you start thinking like a business owner instead of a gambler, everything changes. The questions you ask become so much better. You know, thinking like a business owner is your best defense against making a dumb, impulsive buy. The legendary investor Peter Lynch used to tell this great story about how he'd meet all these doctors who were brilliant in their own field, biotech, pharmaceuticals, but they'd ignore all that and go buy some risky oil stock because they got a hot tip at a cocktail party. It's the perfect example of what not to do. You invest where you have an edge based on a real story, not a tip. So if every stock needs a story, how do you actually write it? Well, that's where the investment thesis comes in. This is your why. It's the whole foundation for why you're putting your money on the line. And Peter Lynch, again, had just a brilliant way of testing this. He said you should be able to explain why you own a stock to a teenager, and they should be able to get it. If you can't do that, if you need a bunch of jargon and complex charts to explain it, you probably don't understand it well enough yourself. Simplicity is a sign you really know your stuff. So what is an investment thesis, really? Here's a simple definition. It's the clear, simple, and specific reasons why a stock is a good business to own at its current price. That last part is key, at its current price. This is your core argument for why you think this investment is going to work out. But here's the thing. A really strong argument isn't built in a bubble. To really know if your idea is solid, you have to actively go looking for the holes in it. You need to understand not just your own thesis, but the counter thesis. You need to know the best argument against your own. This is such a critical discipline. For every bull point you have to be able to argue the bear case. What could go wrong? What are the big risks? Why is someone else on the other side of your trade selling when you're buying? You should actually go read the research from people who think you're wrong. Seriously, if you can't make a good case for the bears, your bull case is probably resting on shaky ground. All right, now for what is easily the hardest part of all of this. Honestly, the math in investing isn't that complicated. What's nearly impossible is controlling your own emotions. And the biggest, most dangerous psychological trap of them all is getting fixated on the price you paid for a stock. Let's just walk through a scenario. You do all your homework, you build out a great thesis, and you buy a stock for $100 a share. You're feeling confident, feeling smart. And then the market does what it does. The stock drops to $70. And suddenly, that $100 price you paid feels like this giant anchor. The emotional part of your brain starts screaming, "Don't sell! Just wait till it gets back to 100, then you can get out even." Listen to me, this is a trap. That $100 is history. It's a sunk cost. It doesn't exist anymore. The only question you should be asking yourself today is, based on my thesis, is this stock a good buy at its current price of $70? If the answer is yes, fine. But if it's no, then the price you originally paid is completely, utterly irrelevant to your decision. Your decision to sell has to be tied to your thesis, not your pride. So when do you sell? You sell when the story changes for the worse. You sell when the facts prove your thesis was wrong. You sell when the business is simply no longer a buy today. What you never ever do is hold on to a bad investment just to break even. That's how you turn a small loss into a huge one. Okay, let's tackle another common trap. This one looks really sophisticated on the surface, but it's often just noise. I'm talking about the false comfort of analyst price targets. We see them all the time. Some expert telling us exactly where a stock is going to be in 12 months. But this creates an illusion of precision that's actually pretty dangerous. I mean, look at this. You'll see forecasts like, our 12-month target is $147.32. Really? Down to the penny? Does anyone actually believe the future is that predictable? It's absurd when you think about it. So let me ask you, when you see a number that specific, does it make you feel more confident in the forecast? Or does it maybe feel a little more dangerous? To me, it suggests a level of certainty about the future that just doesn't exist in the real world. It's a false sense of security. So here's a much better way to think about it. Instead of getting hung up on a rigid price target, think in terms of your level of conviction in your thesis. See, conviction isn't some fixed number. It's a living, breathing assessment of how strongly you believe in the story of the business. It can go up or down as new information comes in, and it forces you to constantly reevaluate the fundamentals. All right, we have covered a ton of ground here. We've talked about moving from emotional gut feelings to disciplined, thesis-driven thinking. So now, let's put it all together into a framework you can actually use. Remember, your investment thesis is the starting point, not the finish line. Your thesis should be the guide that leads you to analyze these 6 key areas. How good is the business itself? Does it have a moat? Who's running the show? Is management any good? How are the financials? Is the balance sheet strong? Is the valuation attractive right now? Are there any chances of a merger or acquisition? And finally, what are the technicals telling you about market sentiment? This is how you build a full 360-degree view. And that brings me to my final thought, which is really more of a challenge for you. Go look at your portfolio. For every single stock you own, I want you to ask yourself this one question. Can I explain my investment thesis, the simple story for why I own this business, in 60 seconds or less? If the answer is no, well, it might be time to do a little more homework. Thanks for watching. You know, when we think about investing, our minds usually jump straight to the hard numbers, right? Things like earnings, revenue, all that valuation stuff. But there's this other incredibly powerful force at play, and that's sentiment. It's the mood of the market, the collective hopes and fears of millions of people. Understanding this psychological dimension, this extra dimension, is really what separates a savvy investor from just being part of the crowd. So today, we're going to break down exactly how it works. All right, here's the game plan. First, we're going to meet a very peculiar business partner who kind of embodies the market's wild mood swings. Then we'll dive into the market's split personality, how it acts like a voting machine one minute and a weighing machine the next. After that, we'll look at the whole strategy of going against the tide, try to understand the deep-seated psychology that makes that so darn difficult, and finally, figure out how to find the right balance in our own thinking. So our first stop is meeting Mr. Market. You see, to really get a handle on the market's emotional roller coaster, it helps to stop thinking of it as an abstract it and start thinking of it as a person, and a very, very moody person at that. The legendary investor Ben Graham came up with this brilliant parable. Imagine the market is your business partner, and his name is Mr. Market. Now, he's a bit of a manic depressive. Every single day, he shows up at your door and offers to either buy your shares or sell you his. Some days, he's just euphoric, totally giddy, and he'll offer you wildly optimistic prices. But on other days, he's terrified, panicked, and willing to sell you the whole shop for pennies on the dollar. The crucial thing to remember is you are under absolutely no obligation to trade with him. You can just shut the door on his silly offers and wait for a day when his mood actually makes some sense. Mr. Market's wild mood swings lead us right into our next point, this constant tug of war between perception and reality. This is really the fundamental conflict between what's popular right now and what's truly valuable over the long haul. The brilliant economist John Maynard Keynes came up with this fantastic analogy. He said, in the short term, the stock market isn't about picking the best company based on its fundamentals. No, it's more like a newspaper beauty contest where you have to pick the face that you think the other judges are going to find the prettiest. It's a game of anticipating what the crowd will do, not necessarily judging objective reality. And this slide just perfectly captures the market's split personality. Ben Graham famously said that in the short run, the market is a voting machine. It's a popularity contest, driven by emotion and what the crowd thinks. But in the long run, it becomes a weighing machine. Eventually, a company's true worth, its earnings, its assets, its actual value, gets recognized and weighed. The real challenge, of course, is surviving that chaotic and often irrational voting period. And this is why sentiment matters so much. When everyone agrees on something, that a stock is a surefire winner or that an entire industry is doomed, that powerful collective perception can completely detach from reality. Prices can stay irrational for a long time. In fact, you'll often find that the moments of greatest consensus are actually the moments of greatest risk. Okay, so if the crowd can be so wrong for so long, how do we turn that into an advantage? Well, that leads us straight to the contrarian strategy, the art of swimming against the tide.
Keynes again just hitting the nail on the head. His central principle was actually pretty simple. If an investment is universally loved, if everyone agrees it's a winner, it's almost certainly already overpriced and therefore unattractive. The real opportunities are found where other people aren't looking, in the assets that the crowd has written off.
Now, a really practical way to apply this is to analyze what's overowned versus underowned. The assets everyone is buzzing about, the ones on the front of every magazine, that's often where perception is at an extreme and the risks are highest. The real value, and often the lower risk, lies in those neglected corners of the market, the companies and sectors that are currently unloved, forgotten about. This kind of analysis becomes a really crucial input for any good buying or selling decision.
Now, this all sounds simple enough in theory, right? Buy what's unloved, sell what's popular. Easy. But in practice, it is incredibly difficult. And that's because our own minds are working against us. This is something that took me years to truly understand. The psychology of price is a seriously powerful force.
Here's the problem. We are all wired to be influenced by price movements, whether we want to admit it or not. It is nearly impossible to completely separate our own judgment of a company's value from the price tag that the market is flashing in our face 24/7. Let me give you a simple, real-world example of what I mean. Okay, imagine you're on a beach in Tuscany. A vendor is selling these nice leather bags. You check one out, do your own mental math, and you decide, okay, this is worth 50 euros to me. So you confidently offer 50. The vendor's face lights up and he immediately says yes. No haggle, no hesitation. What's your very first thought? It's not, great, I got a fair price. It's that sinking feeling in your stomach. Darn it, I offered too much. The seller's reaction, the price action, instantly made you doubt your own valuation. And this exact dynamic plays out in the stock market every single day. You do your homework, you decide a stock is a fantastic buy at $70. The price then drops to $70. Do you buy it confidently? Or do you feel that little prickle of doubt, that voice in your head going, what do other people know that I don't? A falling price creates uncertainty. A rising price, on the other hand, creates confidence. It reinforces our decision, even if the valuation is getting objectively worse. The antidote to this psychological trap comes from Warren Buffett. He reminds us that the market's only job is to provide prices. That's it. It exists to serve you with opportunities, not to instruct you on what your analysis is worth. You have to learn to see Mr. Market's daily quotes for what they are. They're just offers. Offers you are totally free to accept or reject based on your own homework.
Behavioral science has actually given names to these mental traps. There's confirmation bias, where we only go looking for evidence that proves we were right all along. There's overconfidence. That one's especially dangerous after you've had a few wins. And then you've got recency bias, this belief that whatever just happened is going to keep happening forever. Each of these biases acts like an invisible current, pulling us toward the herd and making true contrarian thinking a constant battle against our own human nature.
So, this brings us to the final and most crucial question. Knowing that the market is moody and that our own minds are biased against us, what's the actual path to success? Well, the answer isn't as simple as just ignoring the crowd completely. The answer is not to become some stubborn contrarian who just blindly bets against the market at every single turn. That's just as dangerous as being a mindless trend follower. If you ignore the market completely, you're ignoring potentially valuable information that prices can sometimes carry. The key is not to be in either extreme camp.
The ultimate takeaway is this. Successful investing is an art. It's a really delicate balance. It requires having the confidence to stand by your own independent research, but also having the humility to listen to what the market is telling you, and to seriously question if maybe, just maybe, you might be wrong. It's this blend of conviction and flexibility that really separates the good from the great. So as we finish up here, I'll leave you with a question to reflect on. Take another look at that list of behavioral biases: confirmation, overconfidence, recency. Which one do you see pop up most often in your own decision-making? Because really, understanding your own psychological tendencies, that's the very first step toward finding that successful balance.
So how do you actually build a portfolio of stocks that's set up for success? I mean, that's the big question, isn't it? For every single one of us. It's not just about picking a few good companies. It's about how you structure it, the discipline you have, and your level of conviction. Today, we're going to pull back the curtain and walk through a professional's playbook for putting together a portfolio step by step. All right, let's get into it.
You really have to start right here with this classic idea from Warren Buffett. It's such a powerful challenge to what most people think is safe investing. What he's saying is that real, life-changing wealth, it doesn't come from spreading your money super thin across 50 different stocks. It comes from having the guts and the deep conviction to make a big, concentrated bet on an incredible business that you understand inside and out.
And this really lays out the fundamental tug-of-war that every investor feels. On one side, you've got this philosophy of focus, of concentration, where you're really shooting for those massive returns. And on the other side, you have the standard industry advice: diversify, own 50-plus stocks, spread your risk, which, let's be honest, often just means you end up performing like the overall market. So which way do you go? Well, the answer, as we're about to see, is a little more nuanced than you might expect.
All right, so here's our game plan for figuring this out. First, we'll tackle that concentration versus diversification question head-on. Then, we're going to build a philosophy around conviction. After that, we'll unpack a really powerful technique called the start-from-scratch method. We'll get into the nitty-gritty of sizing your bets and selling with discipline. Then, we'll explore the surprising idea of winning by not losing. And finally, we'll wrap it all up with how to think about offense and defense for your own portfolio.
Okay, let's jump right in. Concentrate or diversify? Even though someone like Buffett is famous for holding just a handful of great businesses, the day-to-day reality for most investors, even the pros, looks a little different. Now, this is where we get a real dose of pragmatism. The author of the material we're looking at, who's a professional fund manager, says his ideal portfolio would have about 50 holdings. But, and this is the key part, it's not because he's chasing diversification just for the sake of it. No, it's a practical problem. When you're managing a lot of money, you can't just put it all in one or two small companies without owning the whole thing. So 50 becomes a number born out of necessity. Okay, so let's build on that and get to the core mindset. Because it doesn't matter if you own 5 stocks or 50, your portfolio has to be built on a clear philosophy. And that philosophy is all about having conviction in what's going to happen, not just analyzing what already did. These are the rules of the road. First, only own a stock if you have a positive, forward-looking reason to own it. Simple, right? This means you don't just own something because it's a big company in the S&P 500. That's a huge point. It also means you have to stop spending all your time looking in the rearview mirror, analyzing what went right or wrong last month. That's a total trap. Your focus has to be on what you believe will work from today onwards. And this quote from Nassim Nicholas Taleb, it just perfectly explains why that rearview mirror thinking is so dangerous. When you get obsessed with the day-to-day or even week-to-week price swings, you're not actually looking at the investment's real potential. You're just watching noise, the random ups and downs of the market. You are, as he says, being fooled by randomness.
Which brings us right back to Buffett. He'd rather have a lumpy 15% return over the long haul than a smooth 12%. So what does that really mean? It means you have to embrace the volatility. You have to accept that the road to better long-term returns is not going to be a nice, smooth, straight line. The goal isn't to feel comfortable every single day. The goal is to get the best possible returns over many years.
Okay, so we've got the philosophy down. But how do you put that into practice? This next section, this might be the single most powerful, most actionable tool from this entire playbook. It's called the start-from-scratch method.
Here it is. This is the one question you have to ask yourself probably every single month. I want you to really think about it. Forget what you own now. Forget what price you bought it at. Forget if you're up or down. If you woke up this morning and your entire portfolio was 100% cash, what would you buy right now? This simple mental trick forces you to look at your current convictions, and it just slices through all the emotional baggage that clogs up our decision-making.
And this is exactly how the author actually does it. He doesn't just think about the question, he turns it into a process. Every month, he forces himself to sort every stock he owns into one of these 5 buckets. It's such a brilliant way to make an abstract feeling, conviction, into something tangible. It instantly tells him where his belief is strongest. Those are his strong buys. And, just as important, it shines a big spotlight on that question mark column, the ones that are telling him, hey, you need to do more research here.
So, once you know your conviction levels, the next step is to make sure your portfolio actually reflects them, right? This brings us to the mechanics of sizing your positions and, just as important, the cold, hard discipline of knowing when it's time to sell.
A pro doesn't just dive headfirst into a full-size position. It's a gradual process. You might start with a tiny starter position, maybe just 0.25% of your portfolio. Then, as your research continues and your conviction grows, you methodically increase the size. It might go from 25 basis points to 50, then to 100. That's a 1% position. A core holding could be 2%, and only your absolute best, highest conviction ideas would ever get to 4% or more. The size of your bet grows with your belief in the idea.
Selling is almost always the hardest part for people. That's why you need a clear, unemotional checklist. And here are the only 3 reasons you should ever sell. Number 1,
Your original reason for buying the stock is just flat out wrong or no longer valid. 2. The stock has reached the price you thought it was worth, time to take profits. And 3. You found a new idea that is just a much better place to put your money. Notice what's not on this list. The stock went down a little, or I got nervous.
And just to really hammer home that third reason, listen to this from another legend, John Templeton. He sets an unbelievably high bar. He's saying don't just sell to buy something that's a tiny bit better. The new opportunity has to be a 50% better deal. This forces incredible discipline and stops you from constantly churning your portfolio and second-guessing yourself.
Now, this all sounds great in theory, but it all depends on one uncomfortable truth. You are going to be wrong. A lot. The real key to long-term success isn't trying to be perfect. It's about how you manage your mistakes. It's about this idea of winning by not losing too badly.
I want you to let this number really sink in. According to our pro, a good hit rate in this business is only 55 to 60%. That means even the best of the best are completely wrong on at least 4 out of every 10 investments they make. Honestly, that should feel liberating. The goal is not perfection because nobody achieves it. This chart just makes it super clear. Out of your next 10 investments, you should fully expect 4 of them to be mistakes. The way you win isn't by getting rid of those 4 losses. The way you win is by making sure that your 6 winners gain a whole lot more than your 4 losers cost you.
So here's the bottom line. Success comes from 2 things: finding a few really big winners and, just as important, being ruthless about cutting the investments that turn into giant portfolio-killing losers. You have to manage your mistakes, control your downside, and let your winners do the heavy lifting. You win by not losing too big or too often.
Okay, let's bring this all home. How can you apply this professional way of thinking? Well, it really comes down to balancing 2 different kinds of work. You have to play offense and you have to play defense.
Think of it like this. Offensive work is the hunt for new ideas. It's all the research, the discovery, the search for that next great investment. Defensive work is taking care of what you already own. It's reading the quarterly reports, staying on top of the news for your companies, and making sure your original reasons for buying still make sense. The big danger, especially as you own more things, is that you spend all your time playing defense and you never look for new opportunities.
And here's one last, really practical tip for managing your offense. Keep a watch list. This is your bench. It's your list of potential investments, companies that look interesting, but that you just don't have enough conviction on to actually buy yet. The author literally keeps physical piles of reports for these companies and reviews them every 3 months. It's a structured way to keep new ideas simmering on the back burner.
So we'll end right where we need to, with the most important question of all. I want you to look at what you own. Now go back to that start-from-scratch method. Is there a difference between what you own and what you would own? Does your portfolio today actually reflect your strongest, most deeply held investment beliefs right now? Answering that question with total honesty, that's the real first step to building a portfolio that's designed to win.
Have you ever opened up a company's annual report and just felt your eyes glaze over? All those numbers, all that jargon, it can be pretty overwhelming. Well, today, we're going to cut right through all that noise. We're going to get inside the head of a professional investor and really pull apart the single most important idea for figuring out if a company is actually healthy. And you know what? It's probably a lot simpler than you think. So let's kick things off with a quote that, I've got to tell you, completely changed how I look at investing. It's from Alfred Rappaport, and it's this: cash is a fact, profit is an opinion. Let that sink in for a second. This one sentence, this is the bedrock for everything we're going to talk about. It's the ultimate filter for separating what's real from what's just a good story. And that's a great question, right? Because profit, earnings per share, that's the headline number. It's what you see on the news. It's what all the analysts are shouting about. But here's the thing. It rarely, if ever, tells the whole story. Sometimes it can actually mask what's really happening under the hood of a business. So yeah, let's dive into that.
Okay, so in this first part, we're going to break down exactly why that number everyone loves, profit, can sometimes be, well, kind of misleading. This is all about getting the difference between what a company claims it earned on a piece of paper and the actual hard cash it has in the bank.
Here's the heart of the matter. Profit? It's an interpretation. It's a number that gets calculated based on a whole bunch of accounting rules and, crucially, management assumptions. Things like how fast you depreciate an asset or exactly when you decide to book a sale. But cash is, well, it's cash. It's the money that physically moved into or out of the company's bank account.
There's no arguing with it. It's a fact. It's real. All right, so if profit isn't the whole story, then what are the pros, the people at the big investment firms? What are they actually spending their time doing? It's not just about plugging last quarter's numbers into a spreadsheet. Nope, that's just the warm-up act. Their real job goes so much deeper than that.
The centerpiece of any professional analyst's work is this incredibly detailed financial model. They're not just looking in the rearview mirror. They are building a massive interconnected forecast for the next 2 or 3 years. It pulls together every single part of the business, sales, costs, assets, debts, to create this living, breathing picture of where the company might be heading. This model is the foundation for everything.
But look, building that spreadsheet, that's just step one. The real work, where the actual thinking happens, is in what comes next. It's about forming the key assumptions that drive that whole model. It's about stress testing your own forecasts against what the rest of the market thinks. And then, it's about walking into a room with a portfolio manager and defending your point of view, usually in a pretty intense debate.
And this quote just hits the nail on the head. Anyone can learn the mechanics of Excel. The real art and science of this job happens in the critical thinking that comes before a single number gets typed in. What do you believe about this company's future that maybe nobody else sees yet? That's the whole game right there.
Now, analysts are constantly checking their work against something they call Smart Street. And this isn't just the average guess from every analyst out there. No, this is the consensus view from the handful of analysts who are considered the best, the most respected, the ones who really, really know that company inside and out. The gap between an analyst's own forecast and Smart Street, that's everything. That gap is a huge driver of the decision to buy or sell.
You know, after years of being around this whole process, seeing the models, sitting in on the debates, seeing what worked and what blew up, I've really learned to simplify my own approach. It all comes down to one really powerful guiding rule that has served me incredibly well over the years. This is it. If you remember one thing from our chat today, make it this. When the story a company is telling gets complicated, when the profit numbers seem a little too good to be true, when you just have that nagging doubt, this principle will cut right through all of that noise. Just follow the actual cash.
So when we say follow the cash, what are we really looking for? Well, it pretty much boils down to these two things. First, is the company a cash machine? Is it generating strong, consistent free cash flow? Basically, after all the bills are paid and it's reinvested in itself, is there a growing pile of cash left over? Think of it like the company's take-home pay. And second, is the business built on a foundation of rock or a foundation of sand? In other words, does it have a healthy balance sheet that isn't drowning in debt?
Okay, so now we know what we're looking for, that cash flow, that strong balance sheet. The next question is pretty obvious. Where do we look for it? And this is where you really do have to put on your detective hat, because the best clues are almost never sitting right there in the headlines.
Look, it's totally natural for companies to want to present themselves in the best possible light. Their main reports are a carefully crafted story. But the real story, the unvarnished, no-spin truth, that's usually buried somewhere else. It's in the details they're kind of hoping you'll just skim over.
So, what's in our detective kit? Well, the most critical clues are almost always hiding in the fine print. I'm talking about the notes to the accounts. You know, that section at the back of the annual report. And even better are the official market listing or IPO documents. That's where you find the absolute gold.
And you have to understand, there's a huge difference in accountability between these documents. An annual report can have some marketing spin, some optimistic language. But a listing document for an IPO? Oh no. Every single word in that document has to be checked, double-checked, and signed off on by armies of lawyers and accountants. The legal risk for getting something wrong is just enormous. And because of that intense legal scrutiny, these documents are the absolute best place to start your research. They give you a much more factual, much less salesy baseline for really understanding the nuts and bolts of a business and, more importantly, the risks. Now, you're probably thinking, this is all great, but isn't this the kind of stuff only the pros can get their hands on? And this is the most exciting part of this whole story. What used to be a secret weapon for big institutions is now an open book. This is where you, the individual investor, have a powerful new advantage. I really can't overstate how much the world has changed here. 20 years ago, you had to be at a big firm to get these documents quickly, to get on the calls. That barrier is just gone. It has been completely leveled. Right now, today, You can go to any public company's website, click on their investor relations section, and get the exact same raw material the pros are using. I'm talking full presentations, every press release, the complete annual reports with all the notes, and even word-for-word transcripts of their calls with analysts. It is all right there for you. And here's my strongest piece of advice. Please take advantage of this access. Don't let someone else filter this information for you. Don't just read a news article or a 2-paragraph summary. Go directly to the source. Read it for yourself. Form your own unfiltered opinion about the company. And that's really what it all comes down to, isn't it? The game has fundamentally changed. It's not about who has access to the information anymore, because we all do. It's about who's willing to apply it. The tools are in your hands. You know the golden rule is to follow the cash. So the only real question left to ask is, what are you going to do with that advantage? You know, we all dream of finding that one stock, the one that's going to change everything. But what if I told you the real secret to building wealth over the long haul isn't about picking the next huge winner? What if it's about making sure you avoid that one catastrophic loser, the one that can just wipe you out? Well, today we're digging into the crucial and honestly often ignored art of evaluating risk. Let's get right into it. And this, right here, this is the perfect place to start. This bit of wisdom from the legendary investor Peter Lynch, it's the foundation for everything we're about to talk about. Trust me, it's a lesson I've learned the hard way, and it is absolutely the key to protecting your money. The biggest, most painful losses, they almost always trace back to this one thing, a weak financial foundation. So here's our game plan. First, we'll look at the anatomy of the disaster, how things really go wrong. Then, we're going to get a systematic tool to decode a company's financial health. After that, we'll talk about why you need to dig deeper than a standard analyst report, how to adopt a more skeptical mindset, and finally, we'll pull it all together into your ultimate defensive strategy. All right, Section 1, the anatomy of a disaster. You know, most investors, they pour all their energy into finding that next 10-bagger. But the real mark of a great investor isn't just about picking winners. It's about consistently sidestepping those portfolio-crushing losers. That, right there, is the name of the game. You know, when I look back over my own investing journey, the most painful lessons, the ones that really cost me, they almost always came down to this one simple common failure. I get seduced by a good story, a promising new product, and I just failed to give the balance sheet the respect it deserved. And when something goes wrong at a company with a weak financial position, well, that's when stock investors can and do lose everything. And this isn't just some theory. These are real-world examples from my own past. iSoft, SMG, Aeronaceous, Johnson Services Group. I mean, 4 totally different companies, right? But they all shared one fatal flaw. They were carrying a ton of debt or other liabilities, and that made their stock incredibly fragile. The second their business started to wobble, that financial weakness acted like an anchor, just pulling the stock price straight to the bottom. Okay, so we've identified the problem. Weak balance sheets are total poison for a portfolio. But how do we systematically find them before they blow up? Well, that brings us right to our second section. We need a solid, data-driven tool to help us assess a company's financial strength, objectively. And that tool is called the H-score. The easiest way to think of it is like a financial health reading. It's on a scale from 0 to 100, where 100 is rock solid. It's built specifically to crunch a company's numbers and predict how vulnerable it is to getting into serious financial trouble. It's a modern, really sophisticated way to flag these problem companies before they make headlines for all the wrong reasons. So, how does this thing actually work? Well, it's not just a gut feeling. First, the system looks at a huge pile of companies that actually failed in the past and compares their financial statements to companies that made it through. From all that data, it builds these mathematical models to figure out the key characteristics of failure. Then it weights 7 key financial ratios and combines them all to produce that one simple score. It's a purely systematic, data-driven process. So if you remember one thing, remember this number, 25. This is the magic threshold. The research shows that it is highly unusual for a company with an H score above 25 to fall into serious financial trouble. Any company scoring below this, well, it's in the danger zone. That's the bottom quartile, and it's a sign that you need to be extremely careful. It's a simple line in the sand. And this isn't just some academic thing. It's a super practical tool. You should be looking at the H-score for every single company you think about buying. And if you already own a stock that falls into that weakest quartile, below 25, it needs your immediate attention. You also have to watch for the trends. A strong company whose score is steadily dropping is a huge warning sign. And if things start to go sideways with one of these low-scoring companies, you sell. You just sell early, even if it means taking a small loss. Now, you might be thinking, hey, don't the professional analysts cover all this stuff? And that brings us to our third section. The hard truth is, a standard broker report, it often doesn't tell you the whole story. To really protect yourself, you've got to go beyond their analysis and do a little digging on your own. I am constantly amazed at how little attention so many broker reports pay to the balance sheet. I mean, I'll read this glowing 10-page report about a company's amazing prospects, and there will be zero mention of the massive mountain of debt sitting on its books. So the real question is, what are they missing, and what should you be looking for? Here it is. This is your checklist of the often hidden liabilities you need to go hunt for. Look at all the debt, from banks, from bonds, all of it. Dig into the pension fund liabilities. Sometimes these can be absolutely huge. Understand what future payments they're on the hook for. And this is crucial. Look at the debt repayment schedule. How much cash do they have to come up with in the next year? And finally, try to get a handle on the debt covenants. Those are the rules the company has to play by to keep their lenders from calling in the loans. Breaking those can trigger a full-blown crisis. And here's a pro tip for you. Some companies, well, they play games with their numbers. They might pay down a bunch of debt right at the end of the quarter just to make their balance sheet look healthier than it really is. That's exactly why you can't just look at the year-end number. You have to ask or look for the average debt level throughout the year. That gives you the real picture of their financial risk. This right here illustrates a hugely important idea. Equity investors, people like us, we're optimists by nature. We're focused on growth, on future earnings. But debt investors, the bondholders, they're completely different. They are pessimists. Their one and only goal is to get their money back, plus interest. They are laser-focused on one thing, survival. So if you see a company's bonds trading at a big discount, that is a massive, flashing red light. The debt market is screaming that they're worried the company might not make it. You gotta listen to them. So listening to the pessimistic bond market is a great start. But now, let's take that idea even further in Section 4. To truly protect your capital, you have to learn how to adopt that skeptical mindset for yourself. You have to learn how to think like a bear. It is an absolutely incredible discipline for stress testing your own investment ideas. So what does that even mean? Well, when you're looking to buy a stock, taking a long position, you're looking for all the positives. A great business, awesome management, a fair price. A short seller does the complete opposite. They actively hunt for the negatives, a weak business, sketchy management, and a sky-high valuation. By forcing yourself to look for these negatives in your own potential investments, you can spot risks that you might have otherwise just glossed over. And why is this so important? Because, as this fantastic quote from John K. Galbraith points out, bad news doesn't travel well. People who know the negative story often have a very good reason to keep their mouth shut. The whole system is basically designed to promote positive news. And what that means is you can't just sit around and wait for the counter-argument to find you. You have to actively go out and look for it. Okay, here's a practical mental exercise you can use right now. Let's call it the downside test. Take any stock you own. First, just imagine its price has been chopped in half. Now, can you come up with a believable story for how that happened? What went wrong? Did they lose a major customer? Did a new competitor just eat their lunch? Did their debt suddenly become a huge problem? If you can easily write that script in your head, then you need to be careful, because it just might happen. And that brings us right to our final section, where we're going to pull all of these lessons together. This is it. This is your ultimate defense, a simple framework for avoiding the most common and the most damaging investment mistakes out there. It really just comes down to these three things. The biggest mistakes that investors make time and time again are investing in companies with poor balance sheets, which we've obviously talked a lot about, but also investing in companies with weak business models, no real competitive advantage. And finally, investing in companies with poor or even outright suspect management teams. If you can avoid these three pitfalls, you are already way ahead of the game. And I really want to leave you with this final personal thought. Looking back, I honestly believe that if I had just followed one single rule to simply avoid every single stock that had a bottom quartile H-score, yeah, I might have missed a few winners here and there, but I would have sidestepped nearly all of my biggest, most painful disasters. The
The protective power of that one simple discipline is, well, it's profound.
So, I'll end this not with a statement, but with a challenge for you. You probably spend a lot of time thinking about your winners, about how high they could go. But take a moment after this. Go look at your portfolio and ask yourself this one simple, critical question. Do you know where your potential disasters are hiding? Have you ever looked at some investors and just wondered, how do they do it? How do they seem to consistently get it right? Well, I can tell you it's not about luck, and it's definitely not about getting hot stock tips. It's about having a disciplined, truly battle-tested way of looking at what a company is actually worth. And today, right here, we're going to open up that very playbook. We're going to go way beyond the noise and learn how to see the value that almost everyone else misses. Okay, this sentence right here, this is the whole game. I want you to really pay attention to the words. The goal isn't just about finding quote-unquote good companies. It's about hunting for something very specific, a valuation anomaly. That's just a fancy way of saying a situation where the market's price tag on a stock is completely, and sometimes wildly, out of whack with its real fundamental value. So here's how we're going to break this all down. First, we're going to get into the core philosophy, the mindset. Then we'll look at the main tool you use to navigate. After that, we'll open the toolkit and see the 5 key ratios you need. Then, and this is crucial, we'll talk about the popular tools you should probably avoid. And finally, we'll talk about how to keep your head straight when the market goes crazy. All right, first things first, we have to get our heads in the right space. This is not about following the crowd. It's about being a detective, systematically looking for those golden opportunities that the herd has either completely missed or just totally misunderstood. So, what does this really mean for you? It means you have to be a contrarian at heart. You're not buying a stock because it's popular. You're buying it for the exact opposite reason. You're buying it because you've done the work and you've spotted a major difference between its price and its actual worth. Your entire bet is that sooner or later, the rest of the market is going to wake up and realize the mistake they've made. Now, this quote gets right to a huge point of tension. Most people in the market, they're always looking for a catalyst. Some big news event that's going to make the stock pop tomorrow. But here's the paradox, and it's a big one. If the reason for the stock to go up was that obvious, the stock wouldn't be cheap in the first place. The anomaly wouldn't exist. The very fact that there isn't a clear, shiny catalyst is often the opportunity itself.
And this chart just lays it all out, clear as day. On one side, you have the anomaly hunter. They're playing the long game. We're talking 1, 2, maybe even more years. They're looking for that margin of safety, which means buying something so cheap that it's hard to lose money. On the other side, that's the conventional view, chasing catalysts, focusing on the short term, and jumping on stocks that are already recovering, where, let's be honest, the easy money is probably long gone.
So what are the actual ground rules here? Well, first, you're usually fishing in the pond of small and medium-sized companies, the ones that aren't covered by 1,000 analysts. Second, patience is everything. It's not just a virtue, it's a requirement. Third, you build a whole portfolio of these ideas. That way, some are always starting to work out while you're waiting on the others. And finally, you have to be willing to buy when other people are still selling. Get in early before it's the hot new thing.
Okay, we've got the mindset down. Now let's talk about the tools of the trade. I mean, if you're hunting for things that are abnormally cheap, you first have to have a really good idea of what's normal, right? And that's where history comes in. It's our compass. I just love this way of putting it. The market isn't a straight line. It's choppy waters. It's chaotic. It's unpredictable. And looking at historical valuations, it's not a crystal ball. It's not going to tell you the future. But what it does do, and this is absolutely essential, is give you your bearings. It tells you, hey, for this particular stock, we're in territory that has historically been very, very cheap. Or watch out, we're sailing in historically expensive seas. Now this is a really big deal. We're not talking about looking at a 1-year chart or even a 5-year chart. No. To do this properly, you need at least 20 years of data. 20. Why so much? Because that's about how long it takes to see a full economic cycle. The big boom, the painful bust, and then the long, slow recovery. Only with that full picture can you really understand what's a normal valuation for a business. And at the end of the day, it all boils down to this one simple, powerful idea. This is the whole strategy in a nutshell. If you consistently buy good businesses when they are cheap compared to their own long-term history, you are systematically, mathematically putting the odds in your favor. It's all about playing the long-term probabilities, not guessing about tomorrow's news. So we have our philosophy, we've got our historical compass, great. Now let's get our hands dirty. Let's open up the actual toolbox and look at the specific instruments we're going to use to measure a company's value.
The million-dollar question, right? Everybody wants to know. What's the one magic number, the single metric that flashes a giant green buy sign? Well, the answer from a seasoned pro might not be what you expect.
And there it is. There is no magic bullet. In fact, relying on just one metric, like the famous PE ratio, is just plain dangerous. Think about it. Every ratio tells you something different, but each one has a blind spot. Using only one is like trying to fly a 747 with only a speedometer. Sure, you know how fast you're going, but you have no idea about your altitude, your direction, or how much fuel is left in the tank. It's a recipe for disaster. So instead of looking for that one magic number, the real pro builds a complete picture, a mosaic, using a whole toolkit. First up, you've got your classic price to earnings, the PE ratio. Simple. Next, EV to EBITDA. Now this one's a bit more robust. It looks at the whole company, debt and all, and compares it to its cash flow. It's a cleaner look. Third, you've got free cash flow yield. This asks a simple question. How much cold, hard cash is this business kicking out? Fourth is EV to sales. This is your go-to for companies that aren't profitable yet. And finally, my favorite, CFROI, cash flow return on investment. This asks the ultimate question. For all the money tied up in this business, how good is it at spitting out cash? You see, together they give you a rich 3D view of the company.
Okay, this part is just as important as the last one. Knowing what tools to use is half the battle. You know what the other half is? Knowing which popular, widely used tools are basically garbage. So let's look at the metrics that this kind of investor actively avoids. And the line here is drawn pretty clearly in the sand. On the left, you've got these serious, institutional-grade analytical systems, rock-solid stuff. On the right, these are the tools you see talked about all the time on TV, but you need to be incredibly careful with them. We're talking about the PE ratio and the big one, discounted cash flow, or DCF. This quote just nails the problem with the PEG ratio. The whole idea of the PEG is to justify paying a really high price for a stock because it's supposedly going to grow super fast. But our investor here says, no way. He'd take the boring company trading at 5 times its earnings and growing at 5% over the exciting one at 20 times earnings growing at 20% every single time. Why? Because your safety, your real margin of safety, is in the cheap price you pay today, not in some heroic guess about the future. And let's talk about the DCF model. Man, these things look so precise and scientific, don't they? All those spreadsheets. But they're built on a foundation of pure guesswork. See, most of the value you calculate in a DCF comes from guessing cash flows way, way out in the future, like 4 to 10 years from now. But let's be real. It's nearly impossible to know what's going to happen in 2 years, let alone 10. So if you just tweak one of those tiny future assumptions by a little bit, the final value it spits out today can swing wildly. It creates this false sense of precision when it's really just a sophisticated guess. And this brings us to the final layer of sophistication. You can't just use the same tools for every single job. You have to adapt. Take a house builder. Their PE ratio is basically meaningless because their profits are all lumpy from selling off big plots of land. What you really want to look at is the price to book value. What are its assets actually worth? For most other companies, a mix of our 5 tools works great. The point is, context is king. All right, we're on the home stretch. We've got our philosophy, our compass, and our toolkit. But there's one last giant piece of this puzzle. You have to recognize that all of this analysis happens inside the crazy world of human emotion and market psychology. So let's see how that affects things. This is such a fascinating and true observation of how markets work. When everyone's happy and prices are going up in a bull market, what happens? Suddenly, people start using more and more aggressive valuation tools to justify the high prices. You hear talk about breakup values and other hypothetical stuff. But then, when the bear market hits and everyone's scared, all that disappears. The focus snaps right back to cold, hard reality, things like dividend yields and hard assets. It shows that the story often follows the price, not the other way around. And this, right here, is the ultimate warning. You have to stay skeptical. You have to be on your guard. When you hear a story that sounds just a little too good to be true, and it's being justified by some brand new, fancy valuation metric you've never heard of before, red flag. A clever salesperson can always find a ratio to make an expensive stock look cheap. Your job, your only job, is to stick to your discipline and the tools that have actually stood the test of time.
And that leaves us with the final and most important question. A question you can now take with you and apply to everything you see. When you look at the market today, when you read an analyst report or listen to some expert on TV, you're now armed to ask the right question. Is the case for this stock built on a solid foundation of value, historical context, and a real margin of safety, or is it just a really clever story, perfectly tailored for today's mood? Honestly, learning to tell the difference between those two things, well, that can make all the difference in the world.
Hello and welcome. You know, we're always looking for that edge in investing, right? Well, today we're diving into one of the most powerful events that can happen to a stock you own, the takeover. It's that moment when you can wake up and see your investment jump 30% overnight. So the big question is, how do you find these companies before everyone else does? Let's get right into it.
So, think about it. How on earth can you get a sudden 30% gain on a stock in a single day without just getting lucky on some wild speculative bet? It's not some Wall Street secret. It's actually a very specific corporate event, and it's something you can absolutely learn to look for.
And that event is the takeover. See, when one company decides to buy another, they can't just pay the price it's trading at on the stock market. Nope. They have to offer a significant premium, a big bonus, to convince all the existing shareholders to sell their shares. And that premium is exactly what we're going to focus on.
So let's talk about this takeover premium. You can think of it as a massive reward for owning a solid, well-run company that a much bigger player decides it just has to have. It's like the ultimate validation of your investment thesis, and it gets paid out all at once.
And we're not talking about a little bump here. The average premium paid in a buyout is a huge 25 to 30% above the stock's current trading price. I mean, that is a fantastic return to get in a single day, just for holding the right company.
But here's where it gets really exciting. That 25–30%, that's often just the starting point. If the company is attractive enough, you might get a bidding war with multiple buyers fighting over it. That's when the premium can just go through the roof. We're talking seriously significant gains. Okay, so the million-dollar question, how do we spot these companies before an offer is on the table? This isn't about chasing rumors or getting hot tips. It's about playing detective, looking for specific, tangible clues that make a company a prime takeover target. Let's run through the checklist.
First up, size really does matter here. It might feel safe to own the giants of the market, the mega-cap stocks, but they're almost never the ones getting bought. I mean, who has the money to buy them? The real action, the sweet spot, is in the mid and small cap space. These companies are just much more digestible for a potential buyer, so focusing your search there will dramatically improve your odds right from the start.
Next, you want to look at the industry itself. Is it consolidating? Think about how all those small regional TV stations in the UK eventually got swallowed up and became the single entity ITV, or how the tobacco industry went from tons of national companies to just a handful of global behemoths. When you spot an industry where everyone's merging, that's a huge sign that the remaining players are likely targets, just as long as regulators don't step in with monopoly concerns, of course.
But there's another clue, and this one is often overlooked because it's kind of hidden in plain sight. It's not in the balance sheet or the income statement. It's in the shareholder list. That's right, who owns the company today can be a massive tell about what's going to happen tomorrow.
Now, this is what a potential buyer absolutely loves to see. They call it a vulnerable shareholder list. It means there's no single family or founder with a controlling stake. Instead, ownership is spread out among a few large institutions. If a bidder can just convince one or two of those big shareholders to sell, they've got a ton of momentum. It makes the whole process so much easier for them. And here's a really important number to understand in any takeover battle: 90%. Now, a buyer only needs 51% to technically take control of a company, but what they really want is 90%. Why? Because at that point, the law allows them to compulsorily buy the remaining 10% of shares. That gives them 100% ownership and, crucially, 100% of the company's cash flow.
Now, that 90% rule creates a really interesting power dynamic. If you happen to be a shareholder or a group of shareholders that owns just over 10% of the company, you have a huge amount of leverage. You can effectively block the bidder from reaching that magic 90% threshold, and you can use that power to hold out for a higher price for all the shareholders.
You know, sometimes the signals are just right out in the open for everyone to see. A great example is MMO2, which was the mobile company spun out of British Telecom. Not long after it became its own company, its own CEO said this. He basically expected to be bought out by a bigger player. Well, guess what? A few years later, Telefonica swooped in and bought them. When you see signs like that, you really need to pay attention.
But I have to give you a word of warning. Holding out for a better price doesn't always work out. Take the story of Sinclair Montrose.
A private equity firm made an offer, but the big shareholders thought it was too low and rejected it. Well, the offer was withdrawn, and the company was delisted from the stock market. Then, its business environment completely changed. Profits collapsed, and investors were left holding shares in a private company that were basically worthless. There was just no way to sell. It's a tough lesson.
All right, so we've spent some time looking at the characteristics of the targets, the hunted. Now let's flip the script and take a look at the hunters. There are really two main types of bidders out there, and they are motivated by completely different things.
So on one side, you have your industrial buyers. These are other companies, often competitors in the same business. They're looking for strategic fit, for synergy, to consolidate a market or gain a new technology. Then on the other side, you have financial buyers, and we're mainly talking about private equity firms here. They care less about strategy. For them, it's all about the financial profile. They're hunting for companies with steady, predictable cash flows that they can use to service a lot of debt. And for those financial buyers, there's one metric that is absolutely king. It's called EV to EBITDA. Now, don't let the alphabet soup scare you. Just think of it as a clean way to measure a company's raw cash-generating power before any accounting tricks or tax considerations. It tells a private equity firm exactly how much debt the company can support, and that is the absolute cornerstone of their entire model.
And this. This is probably the most important insight of this whole explainer. The very same characteristics that make a company a juicy target for a private equity firm, things like predictable cash flow, a reasonable price, a solid balance sheet, are the exact same things that should attract a good value investor. It means if you just focus on being a disciplined value investor, you will naturally end up owning companies that are prime takeover candidates.
Okay, so let's put this all together. Let's create a simple, actionable playbook for what to do if you find yourself owning a company and a bid is announced or you think one might be coming. How should you play it? Let's go over the smart moves versus the really common traps people fall into.
So, what's the game plan? Rule 1, and this is the most important, just stick to your value investing principles. That's your best filter. Now, when a bid does come in, don't be in a rush to sell. That first offer is almost never the best and final offer. And for goodness sake, never, ever buy a stock based on a takeover rumor. That is a game you are almost guaranteed to lose.
And let me just double down on that last point because it's so important. Trying to trade based on takeover tips and rumors is a total sucker's game. It is one of the fastest ways to lose your shirt in the market. The smart money is made by owning wonderful businesses that, for all the right reasons, happen to become a target.
And one last thing, when you're looking at a deal, pay attention to how it's being financed. If you see terms like covenant-light loans, your alarm bells should be ringing. These are basically loans with very few strings attached, which means lenders are getting desperate to put money to work. It's often a huge red flag that the market is getting too frothy or that this specific deal is built on a very shaky foundation.
So, I'll leave you with a question to think about tonight as you look at your own holdings. Is your portfolio just a random collection of stocks? Or have you built a collection of well-run, undervalued businesses? In other words, a collection of potential takeover targets. If you focus on value, you might just find you're doing both at the very same time.
All right, let's talk about what is hands down my favorite type of stock to invest in. We're diving into one of the most powerful and honestly most misunderstood strategies out there, buying recovery stocks. This is all about finding those diamonds in the rough, based on the wisdom from Chapter 10 of Investing Against the Tide. Now, this is a truly contrarian approach, which means you're deliberately going against the herd. It takes guts, it takes discipline, but wow, the potential rewards can be absolutely massive. So let's get into it.
Here's what we're going to cover. First, we'll get into the core philosophy, the mindset you need. Then, we'll talk about the strange allure of unpopular companies. After that, we'll tackle the most crucial skill, how to spot a real recovery and not a dud. Then, we'll get into the nitty-gritty of how you actually buy these things, look at the long-term data on risk and reward, and finally, wrap it all up with why this gives you, the patient investor, such a powerful edge.
So what is the big idea here? What's the secret sauce? Well, at its heart, it's about making a conscious decision to think completely differently from the rest of the market. It's about having the courage, and just as important, the conviction, to zig when you see everyone else zagging. Let's explore the mindset this really takes.
This quote from the legendary investor Bill Miller just nails it. It perfectly captures the mindset. See, this isn't about timing the bottom perfectly. Let's be real, nobody can do that. It's about having deep conviction. When a stock you truly believe in gets cheaper, you don't panic sell. No, you see it as a sale. By buying more shares at that lower price, you bring down your average cost for every single share you own. And over the long haul, that is very often the winning move.
So what exactly are we hunting for? Look, a recovery stock isn't just any old cheap stock. This is a company that has been beaten down, and I mean really beaten down, often for very public and very painful reasons. The performance has been just terrible. But, and this is the key, something is starting to change under the surface. Maybe it's a new CEO, a smart restructuring plan, or a much-needed injection of cash. Most investors are just looking in the rearview mirror and running for the hills. But the contrarian is looking ahead, seeing the hint of a brand new direction.
Now let's get into an idea that might sound a little weird. In this corner of the investing world, being unpopular, being boring, or even being a little bit disagreeable can be an incredibly attractive quality. It seems strange, I know, but these are often the telltale signs of a massive, hidden opportunity. Let's dig into exactly why that is.
I want you to just pause and think about this for a second. What kind of company does everybody just ignore? What are the stories that the big financial news channels just completely skip over? The answers to those questions very often point you directly toward these hidden gems.
The great investor Peter Lynch actually came up with a list of these exact qualities. Think about a company in a no-growth industry, like, say, waste management. It's kind of gross, right? Nobody talks about their waste management stock at a dinner party. Or maybe it's a business that was just spun off from a bigger company and is now completely ignored by all the analysts. These are the exact things that make most investors just turn up their noses. And it's that complete lack of interest that creates the mispricing, the fantastic opportunity for us.
And this brings us to what is, without a doubt, the single most important skill in this entire strategy. You have got to learn to tell the difference between a good company that's just having a bad time and a genuinely bad company that's already in a death spiral. One is a golden opportunity, the other is a value trap. You can see that difference laid out pretty clearly here. On the left, that's our true recovery candidate. It has a solid foundation, good bones, a strong brand, a decent market position. It's just been managed terribly. The key signal is when new management comes in with a clear, measurable plan. They're not promising some magic bullet, they're focused on doing lots of little things better. Now, on the right, that's the value trap. This is a company with a fundamentally broken business model. It doesn't matter how cheap the stock gets, it's cheap for a reason, and it's just waiting to snap shut on unsuspecting investors. And here are a few more really powerful signals. When Wall Street analysts just throw in the towel and stop covering a stock altogether, that is a huge tell. It means the big institutions aren't even looking at it anymore. Same thing with companies coming out of bankruptcy or those with really messy, complicated financial structures. Most big funds just can't be bothered with the hassle. But for you, the determined individual investor, that complexity can create a massive information advantage.
All right, so we've covered the what and the why. Now let's talk about the how. How do you actually pull the trigger and buy when every single fiber of your being is screaming at you to run away? This, my friends, is the art of buying in what we call the discomfort zone.
This really is the psychological battle, isn't it? You have to act before the good news is public. And why is that? Because by the time a company's recovery is obvious and it's all over the news, the biggest gains are already gone. The easy money's been made. This means you have to buy when things look bleak, when the headlines are awful, and when it feels deeply, deeply uncomfortable. And that takes real emotional discipline. So here's a practical roadmap for how to step into that discomfort zone. First, and this is key, you do not go all in at once. You start with a small scout position. This basically forces you to pay close attention without betting the farm. Second, you have to be patient. As the book notes, the first profit warning is almost never the last. You want to wait for signs that the worst is truly over before you build your full position. And finally, if your belief in that turnaround story gets even stronger while the stock price is still falling, well, that's when you follow Bill Miller's advice and average down, strategically lowering the average price you've paid for all your shares. Okay, here is a critical red flag. You've got to watch out for this. It's when a struggling company's management puts out a statement that's just full of vague corporate jargon. Saying things are challenging, but we remain focused. We call that a brave-face statement, and it's often a sign they don't have a real plan and more bad news is probably on the way. You want to see specifics, measurable goals, not those empty platitudes.
Now at this point, you're probably thinking, man, this all sounds incredibly risky. And you know what? You're right, it is. But the potential rewards can be absolutely extraordinary. So let's look at a key concept called asymmetry, and then check out the long-term data that really supports this entire approach.
This right here, this is the holy grail for a recovery investor. It's called an asymmetric payoff.
And it just means a situation where your potential upside is massively greater than your potential downside. So if you're right, you can make 5, 10, maybe even 20 times your money. But if you're wrong, your loss is limited. The example of Cairn Energy is perfect. They had a stable business that was generating cash, but they used some of that cash to drill these high-risk, high-reward oil wells. If a well came up dry, hey, the company was fine. But if it hit, which it did, it was a company maker. That's the kind of skewed risk-reward setup you're hunting for.
And this chart shows exactly why this philosophy works over the long term. See, recovery stocks fall under this bigger umbrella of value stocks, companies that are cheap compared to their assets or earnings. This data from Jeremy Grantham's firm GMO looked at performance over 50 years. And what it found was that these boring value stocks, on average, beat the pants off the exciting growth stocks year after year. And that gap, when it's compounded over decades, turns into an absolutely enormous difference in wealth.
So the big question is, why does this performance gap even exist? Well, Grantham's explanation is just fascinating. It all comes down to something called career risk for professional fund managers. Think about it. It's much safer for their job to buy a popular, exciting growth stock. If it goes down, well, hey, everyone else owned it too. No big deal. But if they buy a struggling, ugly-looking value stock and it goes down, they look like an idiot and they risk getting fired. So because of that career risk, value stocks have to offer a higher potential return just to attract any investment at all. And that pressure, that's what creates the very opportunity that individual investors like us can exploit.
So let's bring it all home. What is the ultimate edge that you gain by adopting this contrarian mindset and committing to playing the long game? It really just comes down to this. The long-term odds are in your favor. Investing styles, they swing back and forth like a pendulum. Growth stocks will have their day in the sun, and then value stocks will have theirs. But over the full arc of an investing lifetime, the historical data is crystal clear. Patience, discipline, and a willingness to buy what is unloved and undervalued is a strategy that provides a significant, durable edge. So I'll leave you with this final thought to chew on. Following the crowd, it feels comfortable, it feels safe. But as we've just seen, it's not always the most profitable path. The real question you have to ask yourself is, do you have the discipline and the courage to step away from the herd and place your bets where the long-term odds are actually stacked in your favor? That is the essence of the contrarian's edge. Thanks for tuning in.
Have you ever wondered what really separates the amateurs from the pros managing billions? It's not some secret formula or a crystal ball. It's often about a certain feel for the market, a set of skills learned over years. So today, we're going to dive into the wisdom of a veteran fund manager to really get a handle on the art of trading, which goes way beyond just the numbers you see on a screen. All right, let's jump right in with a question then. I know, might sound a little strange. What in the world could fly fishing possibly have to do with trading stocks? Well, as it turns out, it's actually a fantastic analogy for getting that feel for the market. It's all about nuance, timing, and you guessed it, patience.
This quote just nails it, doesn't it? Trading isn't about brute force. It's like when you're fighting a fish. You can't just crank the reel as hard as you can. You got to feel the tension on the line, know when to pull, and, this is the important part, know when to let some line out. It's a delicate dance, not just a simple buy or sell command.
So that's really our first big idea here. We're looking at trading almost like an art form. The author really stresses that there's no substitute for hands-on experience, actually buying and selling yourself. It helps you develop an instinct, a feel for the rhythm of the market that, let's be honest, a spreadsheet is never going to give you. Okay. So now let's take that idea and just scale it up. I mean, way up. We've talked about the art of it, but what happens when you're not just trying to buy a few shares for your own account, but you're trying to move millions or even billions of dollars? Well, the game changes completely. You need a totally different set of tools and a whole new strategy. See, at the institutional level, it's a team sport, and maybe the most important relationship is between the portfolio manager, that's the person picking the stocks, and their dedicated trader. A really great trader acts as a filter. They get to know the manager's style inside and out. They understand the urgency, and they cut through all the noise, all the market babble, to pass along only what's actually important. It's this incredible partnership built on trust. So here's the massive headache they deal with every single day. Just imagine you want to buy 1 million shares of a company, but you look at the screen and there are only, say, 50,000 shares for sale at the current price. If you just go and place a huge order for 1 million shares, you're going to send the price skyrocketing before you're even halfway done.
This is the fundamental challenge for these big funds.
And the number one solution to this problem is something called a block trade. So instead of going out into the open market and spooking everyone, institutions will arrange these huge trades privately behind the scenes. This lets them move enormous positions without causing those wild price swings and, tipping their hand to the entire world.
And there is a very clear pecking order for how they prefer to do this. The absolute best way, the cheapest and quietest way, is an internal block. That's a trade between two different funds inside the same investment firm. It's perfect. If they can't do that, they'll look for an outside firm to trade with, and only as a last resort will they go to the open market and slowly, carefully try to build a position.
Now you might be sitting there thinking, wait a minute, why would two managers at the same company be on opposite sides of a trade? Well, it happens all the time, for a couple of key reasons. Maybe one fund has investors asking for their money back, so it needs to sell and raise cash. At the exact same time, another fund has a flood of new money coming in and needs to put it to work. Or it could just be a difference in style. A value manager might decide a stock has gotten expensive and wants to sell, while a growth manager looks at the same stock and thinks it's just getting started.
Okay, let's shift gears now to something really fascinating and super practical. This is a simple little psychological trick that honestly anyone can use to get a small but sometimes meaningful edge when they're placing trades. It's all about understanding a funny quirk of human nature.
So here's the core idea. We humans, we're drawn to simplicity. We just love round numbers. So when we're setting a price limit to buy or sell a stock, our brains naturally go to numbers like 90 or 100 or 110. And because almost everyone does this, you get these huge traffic jams of orders clustered right at those clean, round numbers.
And this table shows you exactly how to use that to your advantage. Most people think in those round numbers. So instead of placing your order to buy at 100, where everybody else is, you put your limit just a little bit higher, at 101. You're basically jumping the line. And on the flip side, when you're selling, instead of setting your limit right at 90, you put it at 89. You're getting your order in just ahead of that big wall of other sellers. It's a simple way to step just outside that big, crowded cluster. The big takeaway here is that by avoiding that crowd at the round number, you just slightly increase the probability that your order actually gets filled. Now, it's not a guarantee, of course not. Trading is a game of probabilities, but a simple little trick like this can tilt the odds even just a tiny bit back in your favor. It's a perfect example of just thinking one small step ahead of the herd. Okay, let's move on to our final section. And this one ties everything together with one incredibly powerful idea, the principle of patience. And I gotta say, this is probably the most important and often the most difficult skill for any investor to truly master. Because the market, it really does have a way of rewarding those who can just wait. So part of this patience principle is understanding liquidity, which is really just a fancy term for how easy it is to buy or sell a stock without moving the price. The big, famous liquid stocks, well, they feel safe and comfortable because they're so easy to trade. But the market knows that, and you often have to pay a premium for that convenience. The author makes a great point that often the better prices, the more attractive deals, can be found in the less liquid, maybe smaller stocks, where you just have to be a little more patient to get your trade done. This right here, this is such a critical piece of wisdom, and it's so hard to remember when you're in the heat of the moment. But unless a piece of news comes out that is truly game-changing for a company, that initial emotional reaction from the market, it often fades. The price might spike up or crash down, but if you're patient, you'll often see it drift back towards where you wanted to trade in the first place, giving you a second bite at the apple. To really nail this idea down, the source uses a great term from the world of golf, a mulligan. Now, for anyone who doesn't play, a mulligan is pretty simple. It's a do-over. You hit a terrible shot, and your friends let you just take it again. No penalty. It's a free second chance. And here it is, the final, powerful idea from the legendary investor Bill Miller. The stock market gives you lots of mulligans. Just let that sink in for a second. You missed buying a stock before it took off? You panicked and sold right at the bottom? The message here is that if you can just control your emotions and be patient, the market will very often give you another opportunity once all that initial excitement or panic dies down. So we'll end with a question for you to think about. If it's true that the market is generous with second chances, if prices often come back to where they were before, then maybe the biggest risk we face isn't picking the wrong stock. Maybe our greatest risk is our own impatience. Maybe the real enemy is that feeling deep in your gut that you have to act right now. Definitely something to chew on.
You know, when most people hear the phrase technical analysis, their minds probably jump to crystal balls, right, or trying to predict the future. But that's not what we're going to talk about today. We're going to look at it from a completely different angle. See it not as some forecasting tool, but as an absolutely essential discipline for any serious investor. So let's just dive right in.
So there's this great quote from the architect Frank Lloyd Wright, and it's always stuck with me. He said, "The truth is more important than the facts." And I think that just perfectly captures what we're getting at here. Think about it. The facts of a company, well, that's the stuff you read in the reports. The earnings, the balance sheet, who the CEO is. But a chart is different. It represents the truth of the market at that exact moment. It's the sum total of every single hope, every fear, every calculation from every investor out there, all boiled down into one line.
So that's the real question, isn't it? When you look at one of those charts, with all the jagged lines going up and down, what are you really seeing? Is it just a bunch of random noise, or is there a deeper story hidden in there? What can that simple picture possibly tell you that a 100-page analyst report can't? It's a fair question.
All right, Section 1, a chart's hidden story, an education in lines. Look, my own understanding of this stuff, it didn't come from some textbook. It was really forged in the fire, through experience. I started out knowing absolutely nothing and learned everything from a few brilliant mentors. It was a journey that, I'm not kidding, completely changed how I see investing.
Okay, let me take you back. We're talking the early 70s. I'm fresh out of university, and I'm in my first real job interview at this small bank. The investment director, he pulls out this big chart of Marks and Spencer and starts talking about it, drawing all these profound conclusions from the lines. And honestly, it was like he was speaking a different language. It meant absolutely nothing to me. So I just sat there, nodding along, totally baffled. But that moment, right there, that's really where this whole journey began for me. Now, luckily for me, at that same bank, there was this wonderful gentleman named Arthur Abrahams. He was a dedicated technical analyst, a real pro. And for whatever reason, he took me under his wing. He's the one who taught me the language of charts, how to spot the patterns, how to use things like moving averages and relative strength. He showed me how to look past the headlines and see what the market was actually thinking. It was a revelation. And you know what? It didn't take long to see just how powerful this was. I remember one of my very first personal trades. It was a tin mining company. And the only reason I bought it was because of this big breakout pattern I saw in its chart, something Arthur had just taught me to look for. I put in 100 quid and made 20 quid profit. Now, okay, it's not a life-changing amount of money, I get it. But the feeling, the validation was just immense. It was that first little piece of proof that, hey, there's something real here. This actually works.
Okay, next up, the peril of a good story. Are you late to the party? This brings us to one of the most, and I mean most, critical jobs a chart has, protecting you from a good story. Seriously. Because in the world of investing, a really compelling story can be the single most dangerous thing out there, especially if you're the last person at the party to hear it.
I remember this one instance so clearly. It was 2007, we'd been in a long bull market, and the big story, the one everyone was talking about, was China. The idea was that their incredible demand for raw materials, for goods, was going to fuel this massive boom in what we call cyclical stocks. And a young fund manager I knew, he'd just gotten back from a trip over there, and he told me, this is the single most attractive investment story I have ever seen. And you know what? He was right. It was an absolutely fantastic story.
But here's what the chart told us. The story was amazing, yeah, but we were very, very late to the game. By 2007, a lot of those stocks had already shot up 3, even 4 times from their lows back in 2003. The chart was basically screaming that all that good news, all that optimism, was already baked into the price. The party was in full swing, and we were the ones showing up just as the lights were about to come on. This is exactly what I call the danger of past the parcel stocks. You remember that game from when you were a kid, right? That's what this is. You've got these companies, the valuation is through the roof, but the momentum is just so strong, so people keep buying and buying, hoping they can sell it to the next guy for a little bit more, before the music stops. A chart is your absolute best defense against being the one left holding the parcel when it all comes crashing down. All right, next section. Finding an unbiased opinion. The need for an objective voice. So, if we all know we can get sucked in by a good story, and that our own biases can totally cloud our judgment, then what's the answer? What do you do? Well, you need a system. More than that, you need an objective, brutally honest voice that just cuts through all the noise. One that tells you what you need to hear, not what you want to hear.
For me, that voice came in the form of a truly delightful guy named Mal Roche. I met him at a conference way back in the 80s, over in Switzerland. He ran this service out of the US called Quantitative Analysis Service, QAS for short. And for decades, he was basically my investing doctor. I'd go to him for a regular, completely unbiased checkup on my entire portfolio.
And the beauty of Mal's system was just how simple it was. He graded every stock based on where it was in its price cycle. You can see it here. D meant it was bottoming out, trying to find its footing. A meant it was in a strong, clear uptrend. B meant it was getting toppy, nearing its peak. And C meant it was in a downtrend. That's it. It was just this simple, clear snapshot of any stock anywhere in the world.
And let me tell you, Mal did not mince words. See, when you're in this industry for a while, people often tell you what they think you want to hear, but not Mal. No way. I'd call him up, all excited about a stock I owned, and he'd just look at his chart and go, "That's a ski slope stock." And you knew exactly what he meant. A steep, fast ride, straight down. Definitely bad news. He was full of these little gems, these wonderfully blunt sayings. If he ever sensed that I was getting a bit too emotionally attached to a company, he'd just cut right through it. "Anthony," he'd say, "fall in love with girls, not stocks." It was his way of giving me a kick, a constant reminder to stay objective, to stay disciplined. And he was always right. And sometimes there was no poetry to it at all. He'd just be brutally and wonderfully direct. He'd look at the data for some stock I was holding, and he'd just say, "Anthony, it's a piece of shit." And you know what? Every single investor, I mean every investor, needs someone like that in their life. Someone who will take their best ideas and just tear them apart with no filter whatsoever. It's invaluable. Okay, let's get to the heart of it, the ultimate discipline. So when you boil everything down, all the early lessons, the painful mistakes, the incredible wisdom from guys like Arthur and Mal, it all points to one central idea. Technical analysis isn't about trying to predict the future. It's about enforcing discipline, right here in the present. This right here, this illustrates the core battle every investor faces. On the left, you've got the emotional investor. That's our human nature, right? It makes us do the exact opposite of what we should. We hold on to our losers, just praying they'll come back to what we paid for them. And then we sell our winners way too early because we're terrified of losing the profits we've made. But the disciplined investor on the right, the one who's guided by the chart, they do the exact opposite. When the chart's trend breaks, you get out, you cut the loss. Simple. And when the trend is strong, you ride it. You let those profits run. The chart forces you to do what's rational, not what feels easy or comfortable. Now, the crucial point here, and I really want to stress this, is that this is not about throwing out fundamental analysis. It's not about ignoring a company's business. It's about combining the two. I've always seen technical analysis as a kind of framework, an overlay I can put on top of my fundamental ideas. So if I find a company I love and the chart confirms my thinking, great, maybe I'll take a bigger position. But if the chart is flashing warning signs, just screaming danger, while my story is telling me to buy, well, that forces me to stop and ask some hard questions. What am I missing here? What does the rest of the market know that I don't? It's a critical check and balance. Okay, our final section, the final verdict, the desert island choice. This whole journey brings me to a final thought experiment. Someone asked me this at a conference a few years back, and it's always stuck with me because it really just crystallizes the true value of a chart.
So imagine this. You're stranded on a desert island. Don't worry, you still have your trading account. But there's a catch. You're only allowed one single piece of information to make all your investment decisions. No earnings reports, no news headlines, no calls with analysts. Just one thing. What would you pick? What would be the one thing you'd choose?
My answer then is exactly the same as my answer is today. Give me an up-to-date chart book. That's it. Because think about it. There are thousands, millions of fundamental data points out there. But a chart contains the summation of all of them. It's the market's distilled truth, right there in a picture. With that book alone, you could navigate the markets. It really is the ultimate survival tool for an investor.
You know that feeling of just being buried in emails, news alerts, and social media feeds? We all get it. But imagine if your entire job depended on sorting through that chaos. For a professional investor, it's not just a distraction, it's the central problem they have to solve every single day. So today, we're going to pull back the curtain and get inside the mind of an expert to see exactly how they turn that overwhelming flood of data into a real, tangible edge.
And this quote from the legendary investor Barton Biggs just nails it.
He breaks the world down into two things: noise, which is all the random, meaningless data flying around, and babble, which is all the opinions and chatter. The real, heavy-lifting intellectual work of an investor, it's finding the tiny, precious signal buried under all of that. It's a monumental task.
And this whole challenge has completely changed the job description. I mean, look at this. 30 years ago, the game was all about getting your hands on information that nobody else had. The job was basically being a data collector. But today, information is everywhere. It's cheap. It's a commodity. So the advantage isn't in having the data anymore. It's about being able to analyze it better, faster, and more creatively than the next guy.
All right, so here's our game plan for breaking this down. We'll start by tackling that barrage of noise. Then we'll talk about why the first step is actually to cast a wider net. From there, we'll get into the nitty-gritty of the daily filtering ritual, then how to find that truly unseen edge, and we'll wrap it all up with what our source believes is the single most important skill in investing.
Okay, let's dive in. First up, facing that barrage of noise. This is the battle every single investor fights the moment they wake up. How do you take this overwhelming mess of information and distill it into something that even remotely resembles actual, usable knowledge?
So how do you even begin to fight back? Well, counterintuitively, the first move isn't to start deleting things. It's to gather more. This brings us to the idea of casting a wider net. The philosophy here is pretty simple. You can't find a needle in a haystack if the needle was never in your haystack to begin with. So a really diverse range of inputs is your absolute first line of defense.
Which, of course, leads to the question that we all ask ourselves no matter what we do for a living, right? Where do the really good ideas actually come from?
An answer, it turns out, is kinda everywhere. You have to be open to a huge variety of sources. Of course, you listen to your own internal team, but you also listen to the big established investment banks, and you listen to the smaller, scrappy specialist brokers who might see things differently. A brilliant idea can surface in a 100-page report, a 2-sentence email, a voicemail, or just a throwaway comment in a meeting. The whole point is you just never know, so you have to be listening.
This quote right here, this explains the entire psychology behind that wide net. Think about it. If you look at an idea and you get it wrong, well, that stings. It's part of the business. But to completely miss a huge opportunity because it never even crossed your desk, that's a different kind of failure. That's a process failure. And that's the professional regret this entire system is designed to avoid.
Okay, so you've cast this massive net. Great. But now you've created a new problem for yourself. You're completely drowning in stuff. And this brings us to the most crucial part of the whole operation, the daily filtering ritual. This isn't about randomly skimming your inbox. This is a disciplined, repeatable, systematic process for turning all that raw input into actual insight.
And this is a great breakdown of that personal funnel. Step 1, intake. Just absorb everything that's come in. Don't judge yet, just let it all in. Step 2, sort. A really fast scan of headlines, just to get the lay of the land. Step 3, evaluate. Now this one's critical. You're hunting for new facts, not just another opinion that confirms what you already believe. And finally, step 4, prioritize. Look, over time you learn who's consistently smart and useful. Their stuff gets moved to the top of the pile.
Now, here's a detail that I just find fascinating. In this hyper-digital age, what's the secret weapon for sorting all this information at high speed? Paper. Yeah, actual paper. For this investor, printing things out and physically sorting through them on a desk is just plain faster and more effective for triaging the daily flood than scrolling endlessly on a screen. Sometimes the old-school way really is better.
In that evaluate step we just talked about, the hunt for new facts, that is a deliberate, targeted weapon against our own worst enemy, confirmation bias. You know, that little voice in our head that loves hearing things we already agree with? By consciously, ruthlessly asking, is there a new piece of information here, or is this just stroking my ego? You build a defense system against your own biases. It's brilliant.
So building a great filtering system is like playing amazing defense. But to actually win the game, you have to go on offense. You have to go a step beyond what everyone else is doing. And that brings us to finding the unseen edge. This is the art of getting beyond common knowledge to find a genuine, sustainable advantage.
And this quote from another investing legend, Bill Miller, just says it all in one perfect sentence. The second something is public knowledge, the second it hits the front page of the Wall Street Journal, its value as an investment idea is probably zero. The market is fast. That information is already baked into the price.
Which leads us to a really blunt but true conclusion. That standard research report that gets emailed out to thousands of people, it's a commodity now. Reading it is just table stakes. It's the price of admission to even play the game.
but it is not a source of competitive advantage. To get an edge, you have to dig way deeper. So where is that edge? It's in the information that isn't a commodity. We're talking about commissioning your own specialized research, not just reading what gets published. It's about finding and talking to experts that the public can't just call up. It's about doing the boring, tedious work of verifying facts that everyone else just accepts as true. And ultimately, it's about spending years building your own proprietary sources, people who give you a unique window on the world that nobody else has.
So all of this, casting the wide net, the daily funnel, that constant hunt for an edge, it all leads us to our final and I think most profound idea. We've been talking about processing information, but what's the absolute pinnacle of skill in this business? Well, it's probably not what you think. It's not about being the person who has all the answers.
I mean, just think about it for a second. The world is absolutely drowning in answers, isn't it? Everyone's got an opinion, a price target, a hot take. There is absolutely no shortage of answers. That's not the scarce resource here.
And there it is. That's the whole game. The real skill, the thing that truly sets the greats apart, isn't about being a know-it-all. It's about being a know-who-to-ask-it-all. It's about judgment. It's about knowing who the handful of truly smart people are, and then knowing what precise questions to ask them to unlock the insights that really matter. It shifts the job from data processor to strategic investigator.
And that brings it all back to us, doesn't it? Whether we're in finance or not. In whatever you do, information is everywhere. The real advantage, the real skill, might not come from trying to learn everything yourself, but from identifying the few people who really know what they're talking about and learning how to ask them the right questions. So the question I'll leave you with is pretty simple. Who are those people for you?
You know, in a world that is just drowning in data, where algorithms are making these split-second decisions, what value could an old-school stockbroker possibly have? I mean, especially inside a research giant like Fidelity. Well, the answer is probably not what you'd expect. In this explainer, we are pulling back the curtain to see why that human element, that human intelligence, might just be the ultimate edge in investing. Think about this statement for a second. This comes from a veteran fund manager at Fidelity, a place with a massive, and I mean massive, internal research team. So why, with all those incredible resources at his fingertips, would he still rely on outside brokers? It feels wrong, almost counterintuitive. But it's actually the key to a really powerful investment strategy that we're about to unpack. And this leads us to what I like to call the broker paradox. You'd think that inside a firm like Fidelity, this would be a totally settled issue, right? But it's not. There's a real active debate raging about the true value of brokers. And that means the choice to use them isn't just some old habit. It's a deliberate, strategic decision. So for this manager, the why really boils down to 4 key advantages. First up, context. It's a reality check. It helps him avoid internal groupthink by seeing how his team's views stack up against what they call the street, the wider market consensus. Second, it's about the flow of ideas, getting this huge, diverse stream of new investment possibilities from outside his own bubble. And the last 2? They're purely tactical. It's about avoiding internal traffic jams. Just imagine, everyone at Fidelity decides to sell the same stock at the exact same time. The price would tank before you could get out. Using an outside broker helps him get his trades done quietly and efficiently, especially when he's dealing with big volumes. But, like I said, not everyone at the firm is on board. You've got real friction here, and the argument against it's pretty compelling. A broker's business model isn't always perfectly aligned with a long-term investor. Their main goal is to generate trades, to get commissions. Plus, there's this nagging concern that the fast-moving, high-volume hedge funds always get the best ideas first. And it's this exact tension that makes understanding how to properly use a broker so incredibly important. So, okay, if the value is up for debate, where's the real secret sauce? I can tell you this. It has almost nothing to do with what most people think of. Those thick, glossy, printed-out research reports. The real value is found somewhere else entirely. Here it is. Your single most important contact at a brokerage firm is the salesperson. Not the star analyst you see on TV, not the chief economist, the salesperson. And you have to forget the stereotype of some simple order taker. A great salesperson is a true partner. They're your filter for all the noise, they're like a personalized search engine, and often they're a brilliant source of independent thinking themselves. And let's break down how this value actually works. A good salesperson doesn't just forward you every single email their firm sends out. They filter. They sift through the noise. They take the time to learn your specific style, what you care about, what you don't. And, crucially, they bring their own ideas to the table, ideas that might be totally separate from their firm's official house view. And finally, they act as your guide, your connector, pointing you to the truly exceptional analysts inside their organization that you need to talk to.
And here we go. This is one of the most important sort of insider secrets of the modern investment world. The official written research you get from most brokers, it's often sanitized, it's censored. Analysts know there are just some things they can't put in writing, either for compliance reasons or just to avoid upsetting a big company's management. So the real insight, the nuance, the stuff the industry calls color, it's not on the page. It's in the tone of their voice during a phone call or the way they hesitate before answering a tough question when you meet them face to face. It's what they tell you when the tape recorder is off. That is where you find the alpha, that little edge that can lead to huge outperformance.
Which, of course, brings us to the core of it. This isn't really about transactions. It's about relationships. You can't get that color, that real, honest insight from a stranger or some algorithm. It absolutely requires trust, and that's something that can only be built over time.
This was a piece of advice our fund manager got way back, early in his career, and he said it became his golden rule. Even in today's crazy digital world, he still insists on meeting the people on the other end of the line in person, because there's just a level of understanding and trust you can only build when you're sitting across from someone.
And cultivating that connection is an active process. You gotta work at it, right? It starts with that first meeting, and then it's followed up by regular sit-downs, at least a couple of times a year. And crucially, it has to be a two-way street. The best managers out there know that it's not just about taking ideas, it's a collaborative partnership.
All right, so with that foundation of trust and relationships, let's get tactical. How does this manager actually process all the information he gets from his, say, 40 or so different brokers? Well, he has a very specific playbook.
Now, he doesn't just toss the written work. As you can see, he consumes a pretty wide range of stuff, from super specific UK company reports to broad global strategy and even deep dives into China. But here's the key. All of this is just one input. It's a starting point for the real conversation.
Okay, get a load of this number. 80%. That is the estimated percentage of research reports out there that are buy recommendations. The default setting for pretty much the entire industry is optimism. And that right there is precisely why he tells his salespeople to prioritize good sell ideas. In this giant ocean of optimism, a well-researched, compelling argument to sell a stock is incredibly rare, and therefore incredibly valuable. It's a signal that just cuts right through all the noise. It shows independent and, frankly, courageous thinking. It's a real game changer.
And here's a quick tactical point that I just love for its beautiful simplicity. He respects his own time and he respects theirs. The relationship is built on efficiency. He tells them, if you have an idea for me, send an email or leave a voicemail. But please, for the love of God, not both. It's such a small detail, but it speaks volumes about a professional, no-nonsense partnership.
Okay, so let's tie all of this together. After years and years of experience, what's the ultimate conclusion here? What truly adds value in this critical relationship? Well, it turns out it's not what he first thought it would be.
You know, at first, his thinking was, well, it was pretty logical. He was drawn to these quantitative systems, these fancy platforms that would track every single broker recommendation and then score them based on how well they performed. It seems to make perfect sense. The data should be able to tell you who's good and who isn't, right? But when he actually put them to the test, something was off. He found a fundamental flaw in the logic. The broker who scored the highest on the system wasn't necessarily the person whose insights were the most useful to him day to day. The data was missing something essential. It just couldn't capture that color.
And the real breakthrough, the final lesson, came from a conversation he had with a hedge fund manager who put it perfectly. He said, "Look, we don't need the very first call. We don't need to know the split second you change your mind. What we do need to know is if you have a strong view, and more importantly, we need to understand the reasons for it. It's not about speed. It's about conviction, and it's about the quality of the thinking that gets you to that conviction." So I'll leave you with this question to think about. In our own lives, in our own work, in a world that is completely obsessed with data, could it be that our biggest blind spot is the very information that can't be quantified?
The stuff that can't be written down, the nuance, the conviction, the color that only comes from real human relationships.
All right, welcome to The Explainer. Today, we're going to talk about something that is so tempting for investors, but it's also one of the most dangerous. I'm talking about trying to time the market. You know, that little voice that says, "Get out now," or "Go all in." It's like a siren's call, promising incredible riches, but man, it has wrecked more portfolios than you can imagine. So what if this secret isn't about having a crystal ball? What if it's just about understanding what's happening right now? Let's get into it. Let's kick things off with this piece of wisdom from the legendary Sir John Templeton. This time is different. Wow, I mean, think about that. Those four little words are probably the most expensive phrase in the entire history of investing. It's not just a quote, right? It's basically a giant warning sticker. It's that little justification we tell ourselves when we're ignoring all the historical evidence, thinking that somehow, this time, we're special. We're the ones who figured it out.
So that leads to the big question, right? If we know it's a trap, why on earth do we keep falling for it over and over again? Well, the answer isn't buried in some complex financial model or a spreadsheet. Nope, it's actually wired right into our own brains. And that's exactly what we're going to break down today. The psychological games our minds play on us that lead to these huge mistakes.
Okay, so here's how we're going to tackle this. We'll start with the timer's trap, then get into your brain on stocks. After that, we'll look at the anatomy of a market cycle. Then I'll give you a contrarian's playbook. And we'll wrap it all up with the long-term perspective.
All right, part one, the timer's trap. And the subtitle here is key, the high price of consensus.
You gotta love Buffett. He just cuts right to the heart of it. You pay a very high price for a cheery consensus. What he's saying is the moment everybody at the party agrees that things can only go up, well, that's probably when you should be looking for the exit. That happy agreement, that cheery consensus, it's not a signal to buy. It's usually a signal that an asset is already overpriced. And notice that last part. It's not the economy that gets us, it's us. We do it to ourselves.
And this leads to one of my favorite concepts in all of investing, and it sounds completely backwards at first. It's called the wall of worry. The idea is that bull markets don't wait for everyone to be perfect. They don't wait for the all-clear signal. In fact, they tend to climb higher precisely when there's a bunch of negative news and pessimism out there. That uncertainty, all those things people are worried about, that's the very wall the market climbs. Kind of weird when you think about it, huh? This is such a great way to put it. Think about it. The cracks, the problems in the economy or with a specific company, they're always there. Nothing's ever perfect. During a bull market, it's like we throw a fancy rug over them. We don't see them, we don't care. But when a bear market hits, it's like a giant spotlight suddenly shines on those exact same cracks. The cracks didn't change, but our perception of them did, completely.
Okay, let's move on to section 2, your brain on stocks. Subtitle, the emotional battlefield. This is where it gets really interesting, because we're about to see that the biggest fight isn't with the market, it's with ourselves.
And here they are, the two big emotions that rule Wall Street, fear and greed. They are the ultimate puppet masters. Fear is what makes you hit the sell button right at the bottom. When everything feels hopeless, you're just staring into the abyss. And then there's greed. Oh, greed is what fuels that FOMO, the fear of missing out, and makes you buy at the very top, totally ignoring all those cracks we just talked about. These two are a brutal combination. Man, Peter Lynch just hits the nail on the head with this one. Everyone has the brain power, not everyone has the stomach. It's so true. You don't need to be a rocket scientist to be a good investor. The real challenge, the thing that separates success from failure, is having the emotional grit, the stomach, to ride out the crazy ups and downs without freaking out.
This is such a fantastic analogy for the market. It's like one of those optical illusions. Is it a smiling face or a grumpy one? The image itself, the actual facts and data of the market, they don't really change that much. What changes is how you see it. When you're feeling good, you see opportunity everywhere, the smiling face. But when you're scared, all you can see is risk, the grumpy one. The picture's the same. Your perception is what's different. So why is it so hard to go against the crowd? Well, it's basically a psychological trap. As markets go up, we naturally get more optimistic. That makes more people buy, which pushes the market even higher. It's a feedback loop. And here's the crazy part. The arguments for why a trend will continue are never more persuasive than right at the very top. And by the way, don't fool yourself into thinking the professionals are any better. They get caught up in the same herd mentality too.
All right, section 3, anatomy of a market cycle, or how the machine works. Now that we know our own brains are working against us, let's look at how the market itself actually operates. It's not what you think.
Okay, this is maybe the single most important concept to grasp about how the market works. It's a discounting mechanism. A better way to think about it is that the stock market is a time machine. It is always looking ahead, maybe 6 to 12 months into the future. It's not reacting to today's economic report or yesterday's news. That's old news. It's trying to figure out what the world will look like next year. So by the time you see something on the front page of the newspaper, the market has already priced it in and moved on.
Now this is really interesting. Market tops and bottoms behave very differently. Bottoms tend to be these sharp, violent, V-shaped events. The turn happens not when good news appears, but simply when the bad news stops getting worse. Tops, though, they're usually a much slower process. They kind of roll over nice and easy. The turn there happens when the good news just stops getting better. That's why bottoms feel so sudden and impossible to catch, and tops can fool you for a very, very long time.
This really breaks down why following the news is a losing game. So, let's say everyone expects the Fed to cut interest rates. The market doesn't wait around for the official press conference. No way. The prices move before that, in anticipation of the event. Then, when the news actually breaks, the big move has probably already happened. It's the classic buy the rumor, sell the news phenomenon.
You know the saying, it's always darkest before the dawn? Well, in the market, that is literally true. The turn at the bottom happens at the point of maximum pessimism. When you feel like selling everything you own and stuffing the cash under a mattress, that's probably the turning point. And listen to this, the market turns when the very last seller has finally thrown in the towel and sold. It's not about the first buyer showing up, it's about the last seller giving up.
Okay, so at this point you're probably thinking, great, I can't trust the news and I can't trust my own brain, so what am I supposed to do? Fair question. That brings us to Section 4, a contrarian's playbook, and what to watch versus what to ignore.
So here's a practical playbook. There are 3 things you want to watch. First, historical patterns. Basically, how long has this trend been going? Is it getting a little long in the tooth? Second, investor sentiment. Is everyone you know giddy about the market or are they terrified? Extreme optimism or pessimism are huge clues. And third, long-term valuations. Are stocks on the whole cheap or expensive compared to their own history? And then, you see that last point? It's maybe the most important. Ignore the current economic outlook. It's a distraction.
A great way to think about this is like a 3-legged stool. You've got historical patterns, investor sentiment, and long-term valuations. If only one of those legs is wobbly, the stool might still stand. But when all 3 start pointing in the same direction, say, a long bull market, extreme optimism, and crazy high valuations, that's when the stool is about to tip over. That's when the odds of a big turn are really, really high.
Which brings us to our final section. And honestly, this is the superpower. This is the ultimate advantage you have as an investor. Section 5, the long-term perspective.
Okay, here's a simple rule that could save you a world of hurt. 3 years. If you're going to need a chunk of cash for anything within the next 3 years, a down payment, tuition, whatever, that money has absolutely no business being in the stock market. End of story. This isn't about being a chicken, it's about being smart. It ensures that you'll never be forced to sell your investments during a downturn just because you need the cash.
And here's a little inside baseball from the great Jeremy Grantham. He points out that for a lot of professional money managers, the real risk isn't losing their clients' money. No, the real risk is being wrong by themselves. It's a career killer to be the only one who missed a big rally. It's much safer for their job to be wrong when everyone else is also wrong. And that fear, that career risk, is what drives so much of the herd behavior you see from the pros. So let's wrap it all up with this. Fear and greed. They are the engine of the market. They have been forever, and they will be forever. They are not going anywhere. The only thing that can change is you. So the final question is really simple. Are you going to let those emotions drive you, or are you going to learn to use them to your advantage? Are you going to be a victim of the herd, or a student of its behavior? The choice, really, is all yours.
All right, let's talk about something every single one of us has to deal with sooner or later. What to do when things are just not going well. We've all been there, staring at our portfolio that's bleeding red, feeling that pressure build. Today, we're going to break down a real, practical playbook for navigating those downturns. This isn't just about survival, it's about coming out stronger on the other side. And let's just kick things off with this quote from Larry Summers, because wow, does it hit the nail on the head.
This is the trap, right? That constant looking in the rearview mirror, kicking yourself for what you should have done. Our whole goal here is to break that cycle, to get you looking forward with a clear head instead of backward with regret. So here's our game plan. We've got a 5-part playbook. First, we'll talk about the investor's pressure cooker. Then we'll get into finding your conviction balance, which is key. After that, we'll cover resetting your mindset, do a deep self-audit, and wrap it all up with how to play the long game. Let's get into it. Okay, first things first. We have to be honest about the world we live in. Investing isn't some academic exercise in a quiet library. It's a real-life pressure cooker, and you have to acknowledge that reality before you can do anything else. See, in a perfect world, you'd just look at the numbers and make a call. But that's not our world. In the real world, you're getting this constant, nonstop feedback loop. Every single day, every single tick of the market is telling you if you're winning or losing. And that creates this massive psychological weight that can absolutely crush your decision-making if you let it. So, what's the antidote to that pressure? It's not about frantically selling everything or making some wild bet. No, your recovery starts with a mindset. It's about finding the right balance in what you believe, especially when those beliefs are being seriously tested. Now this is so interesting. The idea here is to aim for a conviction level of about 50%. What does that even mean? It means you've done your homework, you believe in your idea, but you are also actively embracing the idea that there is a very real 50-50 chance you were dead wrong. It gives you a rudder so you're not directionless, but it keeps you from getting so locked in that you can't see the iceberg right in front of you. It's that sweet spot between strength and flexibility. And this slide just lays it out perfectly. It's a tale of two mindsets. On the left, you've got healthy conviction. You stick to your guns, but you're flexible. You always have an escape hatch, and you're humble enough to admit you might be wrong. But on the right, that's destructive stubbornness. That's where you dig in your heels, you back yourself into a corner, and you start ignoring any piece of information that doesn't fit your narrative. Your number one job in a downturn is to live on the left side of this chart, period. So once you've found that 50% conviction balance, what's next? Well, it directly impacts how you interact with the world around you, especially with criticism, which is exactly what you need most when you're underperforming. You know, our natural instinct when we're losing is to turtle up, to build a shell and hide. This is about doing the exact opposite. You need to actively hunt for criticism. Go to that person you respect and ask them, point blank, tell me what I'm missing here. Where am I wrong? And that last point is huge. Define what failure looks like for an investment before you even buy it. That way, you have an objective tripwire, not an emotional excuse. Here's a great little gut check for you. If you look around and absolutely everybody agrees with your position, you should be a little nervous. Why? Because your conviction might not be your own. You might just be riding the wave of popular opinion. And when everyone agrees on something, it's usually already priced in, which means there's not much upside left, but there's a whole lot of downside if the tide turns. And here's the counterbalance, because this is really important. Being open-minded doesn't mean you just throw your entire philosophy out the window. The absolute worst thing you can do is panic and start chasing some hot trend that you don't really understand or believe in. Think of yourself as a ship's captain in a storm. You stick to your core principles of navigation, but you have to be willing to turn the wheel to avoid the waves. Okay, so we've got the mindset dialed in. Now it's time to roll up our sleeves and do the work. We're moving from feeling to fact. These are some concrete analytical tools you can use to get real clarity on your situation. I absolutely love this exercise. It is so simple, but man, is it powerful. It just slices through all the emotional baggage we carry around with our investments, the inertia, the hope that a loser will bounce back. Just pretend you have 100% cash today. What would you buy? The difference between that ideal portfolio and the one you actually have, well, that gap is your action plan. It's telling you exactly what you need to do. All right, next up is one that's, well, it's not fun, but it's absolutely crucial. A post-mortem on your mistakes. Make a list of your worst investments and be brutally honest about why they went wrong. And look for the patterns, the common denominators. Do you always fall in love with a good story? Do you ignore macroeconomic trends? Finding those patterns is like finding the crack in your foundation. You have to see it before you can fix it. This is a big one. Think about your day yesterday. Who was in charge? Were you proactively researching new ideas, working on things you decided were important? Or were you just reacting, bouncing from one market alert to the next, glued to the screen? The answer tells you whether you're driving the process or if the market's noise is driving you. And here's how you take back control.
These are the habits you need to build. You have to intentionally block out time for deep work, for finding new ideas, not just babysitting your old ones. And that last point is so important. Check for those hidden, unintended bits. You might think you have 10 different stocks, but if they all go down when interest rates go up, you don't have 10 bets. You have one big bet on interest rates. You need to know that.
And finally, let's just pull the camera all the way back, because this isn't just about getting through a bad month or a bad year. This is about building a career, a process that can last for decades through all the inevitable ups and downs. When you're in that dark place, the temptation to just disconnect is huge. You stop talking to people, you avoid looking at your accounts, you start to believe there's nothing you can do. That's fatalism, and it is the most destructive thing you can do. You have to fight it. Reach out, talk to people. Engagement is your lifeline back to clear thinking. And this right here, this might be the single most important lesson of all: humility. Because things will turn around. You'll have good runs again. And when you do, you have to remember what the bad times felt like. That memory is the vaccine against the arrogance and overconfidence that always leads to the next big mistake. Nobody walks on water. So when you put it all together, what does it mean? It means the goal isn't to somehow magically avoid tough times. They're gonna happen. They're part of the game. The goal is to have a structured, repeatable process, a playbook that you can pull out to not just survive, but to actually learn, adapt, and turn that period of weakness into a source of incredible strength for the future.
So we've laid out the framework for you, but knowing the playbook and using it are two different things. So the question I'll leave you with is this: the next time that pressure really starts to build, what will be your first deliberate move? That first step is up to you. Thanks for watching.
All right, let's get into it. Today we're going to break down the 12 qualities that make a truly elite investor. But here's the thing: you don't have to be a portfolio manager for this to be incredibly useful. What we're really talking about is a masterclass in high-performance thinking, something you can apply just about anywhere. So, to kick things off, I want to borrow a phrase from Winston Churchill. Now, he wasn't talking about an investor, but man, did he nail the essence of our very first quality. This idea of the seeing eye. It's the perfect way to start thinking about what separates a truly great strategic mind from, well, everyone else.
All right, so this seeing eye, it's not just about, having good eyesight. It's about seeing around corners. It's about being able to predict the ripple effects, the second, third, even fourth consequence of something happening that most people just don't see coming. It's really the difference between seeing your next move on the chessboard and seeing the entire game 10 moves ahead.
Let me give you a classic example. Okay, so the dollar falls. Almost everybody gets the first part. That's bad for UK companies trying to sell stuff to the US, right? Simple enough? But the investor with that seeing eye, they're already onto the second effect. This is a huge win for UK retailers who buy their goods in dollars. See? They're not just looking at the one piece on the board. They're seeing how the whole game just shifted.
Now, having that kind of vision is one thing, but it's totally useless if you don't have the right internal wiring to actually act on it. And that brings us to our next big quality, which is all about mastering what we'll call the inner game, your own psychology. And this is where we get to a really crucial, maybe even a controversial point. In the high-stakes world of investing, temperament, it beats raw intelligence. I mean it, every single time. You could be a card-carrying genius with a stratospheric IQ, but if you panic and sell at the bottom or get cocky after a big win and make a dumb mistake, all that brain power is completely worthless.
You see, these traits, they're not optional. Because this job doesn't have a finish line. It's a marathon that never, ever ends. And it demands this relentless intensity. You have to have the humility to know they're going to be wrong, a lot, and see those mistakes as part of the process. And then you need the stamina to dust yourself off, learn from it, and get right back in the race. Day in, day out.
And a huge part of this temperament is being okay with standing alone. Look, most people get a ton of comfort from running with the herd. It's human nature. But here's the paradox of great investing. The decisions that make you the most money, the ones that are real game changers, they almost always feel incredibly uncomfortable, even downright lonely, right when you're making them. This quote from John Maynard Keynes just nails it. It perfectly explains that huge social pressure to just go along with everyone else. Think about it. It's way safer for your reputation to fail the same way everyone else is failing than to succeed in some weird, unconventional way. A truly great investor has to fight that powerful, primal urge to conform every single day. Okay, so if the inner game is all about your mindset, then the outer game is your playbook. It's the actual stuff you do, the habits you build, the disciplined process you follow day in and day out. This really gets to the heart of intellectual curiosity. A top analyst isn't happy just knowing what happened. They're obsessed with how and why. They have to take the machine apart to see how all the gears fit together. Just being told it works is never enough. And, there's a classic way to test for this kind of mindset, with a question that seems super simple on the surface. Now, let's be clear. The actual answer to this question is totally irrelevant. Nobody knows the answer. Nobody cares. What matters, what reveals a truly analytical mind, is how you attack the problem. It's all about the process. See, a great analyst doesn't just freeze up when you throw an impossible question at them. Their brain immediately starts building a framework. They start breaking it down into smaller, solvable chunks. Okay, let's look at the demand side. Then let's cross-check that from the supply side. It's just a beautiful thing to watch. You're seeing structured, analytical thinking happen in real time. And you absolutely need that kind of structured thinking, because every single day, the world just throws this fire hose of chaotic, unstructured information at you. If you don't have your own plan, your own agenda, you're just going to get pushed around by whatever the market is doing that day. I mean, the classic rookie mistake is starting your morning glued to the screen, watching all the flashing red and green. A disciplined pro, they often ignore the market completely for the first hour, focusing on their own research first. Look, this disciplined process isn't just some nice-to-have academic exercise. It's your weapon, because investing, at its core, it's not a team sport. Jeremy Grantham puts it bluntly. It's a poker game. It is a brutal, competitive, zero-sum game. For you to win, someone on the other side of that trade often has to lose. And your edging that game doesn't come from getting lucky. It comes from your process. So you've got the right temperament, you've got a rock-solid process. That's fantastic, but it's still not enough. See, success has to be sustained. We're not talking about one good quarter or one great year. We're talking about a whole career. And that takes a whole different kind of quality, endurance. It's all about playing the long game. And this is maybe one of the toughest balancing acts in the business. On one hand, you need to have incredible conviction to make a big bet and stick with it when everyone else thinks you're crazy. But on the other hand, you need the humility to instantly say, you know what, I was wrong, the second the facts change. That line between conviction and just being pig-headed is razor thin. And if you step over it, it can be absolutely catastrophic. Which brings us to a classic trap. I love this one. It's called the Icarus Syndrome. You see it all the time. Some brilliant young manager is on a hot streak. Everything they touch turns to gold. They've only ever seen a market that goes up. They start to look and feel invincible, but they haven't been tested by a real storm, a proper bear market. And that's the only thing that can tell you if their wings are made of solid steel or just wax and feathers. Because real experience, the kind that's truly invaluable, isn't measured in just years. It's measured in cycles. You're not really a seasoned pro until you've lived through a full cycle. The crazy boom, the painful bust, and the slow climb back. That's what gives you the context to see what's happening today and recognize when history is starting to, well, rhyme. And finally, holding all of this together are two bedrock traits: integrity and just plain common sense. Integrity isn't just about being honest with your investors. It's about being brutally, painfully honest with yourself when you screw up. And common sense, that's your ultimate BS detector. The author tells this great story about being pitched these super complex financial products right before the '08 crisis. He couldn't even figure out how to model the risk, but the basic idea, you get huge returns with zero risk, it just failed the common sense test. It sounded way too good to be true. And that simple gut check, it saved his clients from getting completely wiped out when the whole thing blew up. Okay, so we've gone through all this stuff. The vision, the temperament, the process, the endurance. But it all comes down to one big question, right? How do you actually know if a manager is the real deal, or if they've just been on a lucky streak? Well, the only real answer is time. The source material is pretty clear on this. You need at least 3 straight years of great performance before you can even start to tell skill apart from pure luck. I mean, think about it. 1 great year, anyone can get lucky. 2, maybe it's a coincidence. But 3 years in a row? Okay, now you're starting to see a pattern. Now you might be looking at real, repeatable skill. And that's exactly why that hard-won, cycle-tested experience is so critical. A seasoned manager has heard this song before. They recognize the melody of a market bubble, they know the rhythm of a coming recession. And that allows them to navigate what's next with a kind of context that a rookie, no matter how smart, just can't possibly have. So when you boil it all down, these 12 qualities, they're not just a checklist for how to pick an investor. They're really a blueprint for how to think better, how to make better decisions in any complicated part of your life. Which leaves us with one final big question to chew on. In a world where you can look up any fact in a split second, is the most valuable thing you have not what you know, but how you think?
You know, have you ever wondered what it would be like to be a fly on the wall in thousands of company meetings? I'm talking about decades of them. Well, today, we're doing just that. We're cracking open an investor's private notebooks to get a look at the raw, unfiltered insights you can only get from sitting face-to-face with the people in charge. This isn't about spreadsheets or algorithms. This is about the human side of investing.
And look at this number. We're talking about roughly 8,700 meetings. That is a staggering amount of conversations, enough to fill nearly 90 handwritten notebooks. This isn't just data, it's a living, breathing record of corporate history. The big wins and, oh boy, the spectacular failures, all captured in real time.
And this quote right here, this really gets to the heart of it, doesn't it? This is why these notebooks are so special. This isn't some collection of polished press releases. No, this is a peek behind the curtain. It's about those moments where a manager, maybe someone not used to being questioned, just accidentally lets something slip, something they really shouldn't have.
All right, so here's our roadmap. First, we're going to dig into the power of these notebooks themselves. Then, we'll take a trip back in time to the wild frontier of 1980s European investing. We'll hunt for hidden gems and, just as importantly, learn how to spot the red flags that scream disaster ahead. It all builds to the single most important lesson from all these years, and then we'll ask, what does this old-school wisdom really mean for us today?
So let's start with this library of lessons. We're talking about 52 notebooks packed with meetings from UK companies and another 37 just for European firms, with the first entry dating all the way back to 1985. Just think about that. It's a private, analog database of how business really works.
Now, here's the crucial part. These notes weren't just about recording facts and figures. Their real value was as supplemental intelligence. You know, capturing the stuff you can't quantify, the body language, the tone of voice, that off-the-cuff remark that reveals everything. Back then, before you could get any piece of information in seconds, this was a massive, massive advantage. It was a layer of human insight you'd never ever find in an annual report.
And to really get why this was so powerful, we need to hop in a time machine. Let's go back to the 1980s, when investing in Europe was a totally different ballgame. Forget about investor relations departments or fancy PowerPoint presentations. Information was scarce, and you had to go out and get it yourself.
I mean, look at the difference. Back then, so many companies were these deeply secretive, often family-run operations. The very idea of an investor from London showing up on their doorstep was, well, it was a novelty. This created a huge information gap. And a single face-to-face meeting could give you an edge that is almost impossible to imagine in today's world of just complete information overload.
And this little story from the notebooks just says it all. On a trip to Norway back in '83, a local chief investment officer flat out admitted that the best research on his own country's companies was being done in London. Can you believe that? That's how big the information vacuum was. You just had to be there.
And the reception you'd get was a total roll of the dice. You had the Danish shipping giant A.P. Miller, who basically told you to get lost. They just didn't meet with investors. But then you'd visit a small German property company, and they'd be so surprised anyone was interested, they'd spend hours with you, spreading maps all over the floor, showing you every single asset. Sometimes they were so unused to outsiders, they'd just hand you their internal management accounts. It was truly the Wild West.
So you can imagine, after all that effort, knocking on doors, flying all over Europe, the thrill when you actually found something. This wasn't just about finding a good stock. It was about genuine, old-fashioned discovery, uncovering incredible stories that the rest of the market had totally missed. And the story of Nokia is the absolute prime example. On paper, it was this messy, sprawling Finnish company making everything from TVs to rubber boots. But buried deep inside was this tiny little division called Mobira, making mobile phones. The light bulb moment came in one meeting in 1993. Because the company didn't break out its profits by division, nobody knew that massive losses from their TV business were completely hiding a gold mine in mobile phones. That one meeting laid the real story bare. And, well, you know the rest.
And hey, Nokia wasn't just some lucky shot in the dark. This was a process. The same approach led to finding Sonai, a Portuguese company that went up 10 times in value. Or this Finnish IT firm, TTT Tieto, where the note from right after the meeting literally identified it as a potential 10-bagger. That's investor talk for a stock that could go up tenfold. And you know what? It did.
But discovery isn't always about finding the next big thing. Sometimes the most valuable thing you discover is that cold knot in your stomach. That little voice telling you that something is very, very wrong and you need to get out now.
I mean, seriously, picture this. This is a real story. You're visiting a Spanish company called Torres Hostench. The CEO keeps getting interrupted. And then to go to lunch, literally 50 yards across the street, you all get in a car with 2 armed bodyguards. The whole thing just felt off, deeply wrong. The shares were sold right after that trip, just before the company imploded in one of Spain's biggest bankruptcies.
But the scariest red flags aren't always so dramatic. Sometimes the real danger is when everything seems too calm. Take another company, Parkfield. The finance director was smooth, reassuring, sitting in this quiet, peaceful headquarters insisting everything was fine. A few months later, the company went into receivership. It was a painful, expensive lesson. Never, ever let a manager's calm reassurance make you ignore the hard numbers. A smooth talker can be the most dangerous person in the room.
And these notebooks are just filled with warning signs like these. The German finance director knocking back champagne at a breakfast meeting. The company that lets you fly all the way there and then cancels on you when you're standing in their lobby. Or even charismatic guys like Ozil Nadir of Polypec, incredibly charming, cultured, believable, all while his company's finances were stretched to the absolute breaking point.
So you see, all of these painful disasters, Polypec, Parkfield, the others, they weren't just a string of bad luck. They were all pointing to one single, overarching, absolutely critical lesson. The ultimate lesson, really.
And here it is, the balance sheet rule. It's simple, really. After getting burned one too many times by companies that collapsed under a mountain of debt, a new rule was forged. Always, always scrutinize the balance sheet. No matter how great the story sounds, no matter how charismatic the CEO, a weak balance sheet is like a crack in the foundation. It can bring the whole house down.
The story of the ad giant WPP is the perfect example of this rule in action. They went on this massive, debt-fueled shopping spree in the late 80s. Then a recession hit, and that debt almost killed them. But, and this is the key part, they managed to pull off a complex refinancing. They fixed the balance sheet. And once they had that solid ground underneath them, the company didn't just survive, it thrived, eventually becoming so successful it joined the FTSE 100.
And this really drives the point home. A refinancing that big? It's usually the end of the line for a CEO. It's an admission of failure. The fact that Martin Sorrell pulled the company through it and then stayed to lead it for decades after is just incredible. It's a powerful reminder that with the right leadership, even a company on the brink can come back stronger as long as its finances are put in order. So, after hearing all these stories from the notebooks, the incredible discoveries, the near-death experiences, the hard-won lessons, what does it all mean for us today, in a world where we're practically swimming in data?
Let's be honest, the world is unrecognizable from the 1980s. The idea of a company displaying its own share price used to be a rare sight in Europe. Now it's everywhere. That old-school information edge, knowing something just because you bothered to show up, that's pretty much gone forever.
And that brings us to the final, really important question. As we rely more and more on algorithms, on big data, on Zoom calls instead of handshakes, what are we losing? These notebooks are a powerful testament to the value of human intuition, of the gut feelings and the subtle signals you can only get by being in the same room. In an age of endless data, maybe the most valuable insight of all is the one you get from just looking someone in the eye. All right, welcome. Today we're going to do something a little different. We are going to step inside the mind of a seasoned fund manager and look over his shoulder at his biggest wins and, maybe more importantly, his most painful losses. Look, this isn't going to be some textbook theory. This is the real world, the decisions that literally made and lost fortunes, and the timeless lessons that came out of it. So here's how we're going to break this down. First, we'll look at the raw scorecard, the unfiltered hits and misses. Then we'll put on our detective hats and dissect a big win to see what made it work. After that, and this is crucial, we'll do a post-mortem on the losses, because that's where the really tough lessons are. Then we'll get into the gray areas of bias, before we boil it all down into the core lessons you can take with you.
Okay, first things first. Let's just lay it all out on the table.
You know, every single investor has a track record, and it's always a mix of brilliance and, well, blunders. The goal isn't to be perfect. No one is. The goal is to be brutally honest about the results and to learn something from every single one.
And here it is, right there in black and white. On the left, you've got the rockets, the names that really propelled the fund's performance. And on the right, you've got the anchors, the ones that really dragged it down. These were the top 10 wins and losses from 2000 to 2007. Right now, they're just names on a list, right? Autonomy, Sporting Bet, Cairn Energy. But trust me, behind every single one of these names is a story, and we're about to find out what made them fly and what made them crash.
All right, let's kick things off with the good stuff. It's always easy to look at a stock chart that went up and to the right and say, yeah, I would have bought that. But what was the actual thinking before it took off? What was the insight, the edge that led to these massive wins? Let's decode them.
So our first success story is an oil exploration company called Cairn Energy. And this one wasn't just about picking a good company. It was about picking it at the right time, having the guts to sell at the right time, and then, crucially, having the conviction to jump back in when no one else would.
This chart just says it all, doesn't it? The light gray line is the stock price, and that black line shows the fund's position. So you can see the manager had already made a ton of money on this stock, selling out near the peak back in '97. But here's the magic. When the company hit a rough patch and the market absolutely panicked, sending the stock into a nosedive, he didn't run for the hills. He saw a massive opportunity and started buying again, aggressively at dirt cheap prices. It is a perfect, real-world example of that famous saying, "Be greedy when others are fearful."
So you might be asking, what gave him the confidence to charge back in when everyone else was sprinting for the exits? Well, it all boiled down to one thing: trust in the management team. He knew their strategy was solid. They were using their safe cash cow assets to fund these high-risk, high-reward exploration bets. And that exact strategy led them to buy a tiny little asset from Shell in India for just £7 million. Well, that little bet turned into a discovery now worth billions. It's just one of the all-time greatest business deals, and it all came from backing a team with a plan.
Okay, next up is a big win that came from a totally different place: understanding a specific kind of corporate event called a spinoff. You know, sometimes the way the market is structured actually creates these little pockets of opportunity if you just know where to look. And that brings us to the mobile company MMO2.
This was just a classic spin-off play. See, when British Telecom, or BT, spun off its mobile division as MMO2, every single BT shareholder suddenly got a few shares in this new, smaller company. And what did most of them do? They sold immediately. They didn't want it. That created this huge wave of selling pressure and a super attractive entry point. The fund was on the other side of that trade, buying up what everyone else was dumping, basically betting that a newly independent, highly motivated management team could finally unlock the business's true value. And that's exactly what they did.
And the last win we'll look at, ICAP. It really shows the power of spotting a huge technological shift before the rest of the market wakes up to it. So the manager had been following this old-school telephone-based money-broking industry for years. He saw that ICAP was making a massive early bet on electronic trading. I mean, they were pouring cash into technology while all their competitors were literally still just yelling down the phones. That bet, that a fundamental part of the market was about to change forever, it allowed them to completely dominate the industry. And man, did that investment pay off.
All right, now for the hard part. Looking at the wins is fun, but the most valuable, the most humbling, and the most lasting lessons, they always come from the investments that went south. You have to be willing to stare your mistakes in the face because it's the only way you learn not to make them again.
The single worst performer in the whole portfolio was an online gambling company, Sporting Bet. And this slide just perfectly captures the disaster. The fund knew there was some legal risk around its U.S. business, so they did their homework, right? They talked to tons of legal experts who all said the same thing: a ban was extremely unlikely. But political reality blew up the legal advice. At the last minute, a couple of U.S. politicians tacked an anti-gambling clause onto a completely unrelated port security bill. And just like that, it became law. The stock was absolutely decimated. It's such a brutal lesson that some risks, some black swans, are just genuinely impossible to see coming.
The loss on Premier Foods was totally different. This one was a painful self-inflicted wound. This wasn't some surprise event out of left field. This was a complete failure of discipline. The manager was really impressed by the management team. But a broker he trusted called him up and told him, point blank, to sell, because the company's balance sheet was just dangerously loaded with debt. And he ignored the advice. He broke one of his own cardinal rules about avoiding weak balance sheets, and he paid the price. Simple as that.
And then there's iSoft. This is a classic investment trap, falling in love with a beguiling story. I mean, the narrative was just irresistible, right? A little British underdog beats all the global giants to win this massive government contract. The CEO was charismatic, he sold the dream perfectly. The only problem? The story was basically fiction. The fund completely missed the aggressive accounting that was hiding a balance sheet that was crumbling from the inside. The story was so good, it blinded them to the ugly reality underneath.
Of course, investing isn't always a clean win or a clear loss. Sometimes the biggest mistakes are the things you don't do, or the result of biases you don't even know you have. So let's dive into these gray areas where things like past success and your own prejudices can really cloud your judgment.
For over a decade, the manager had an absolutely fantastic run with UK broadcasting stocks like ITV. He knew that sector inside and out. But that past success? It became a blind spot. He was just too slow to see the massive tidal wave of technological change that was about to crash over their old business models. It was almost like a kind of nostalgia for his old wins made him hold on for way too long, underestimating the new competition. He paid for it.
And that brings us to a really crucial point. Every single investor has biases. This chart gives you a rough idea of this manager's portfolio. Look at how tiny that resources slice is. See, he always had a bias against mining and energy stocks. His thinking was that their fortunes are tied to commodity prices, and predicting those is a total guessing game. He preferred to stick to what he could analyze, a company's management, its balance sheet, its market position, instead of making some huge bet on where the price of oil was going.
And here's the punchline, the real cost of that bias. While he was sticking to his very logical framework, a massive commodity supercycle, basically a rocket ship fueled by China's growth, was taking off. He missed out on incredible gains in mining stocks, not because he analyzed them and got it wrong, but because his intellectual framework screened them out from the very beginning. It's just a powerful reminder that a bias that feels smart in one market can be a huge liability in another.
So, after going through all these stories, the good, the bad, and the biased, what are the big principles we can pull from all this? Let's try to boil down decades of experience into a clear, actionable set of lessons. Okay, so what did the big wins teach us? First, you back strong, motivated management teams. Think of the team at Contrarian Energy making that unbelievable deal. Second, you look for value in complex situations that other people might overlook, like that MMO2 spinoff. Third, find companies that are riding a big wave of technological change, just like ICAP did with electronic broking. And of course, none of this works without deep, deep industry knowledge.
But you know, the losses often teach us the most important lessons. The number one red flag, a weak balance sheet loaded with debt. That was the Premier Foods mistake. You have to be incredibly skeptical of a great story that isn't backed up by solid numbers. That was the iSoft trap. You have to accept that some risks, like the political one that torpedoed Sportingbet, are just unknowable. And finally, you have to know yourself. You have to be aware of your own blind spots, like that media stock nostalgia or the bias against resources, and know when it's time to change your mind.
So I'll just leave you with this final thought. Look, technology changes, markets go up and down, and the headlines are different every single day. But these fundamental lessons about backing great people, demanding financial strength, avoiding seductive stories, and knowing your own weaknesses, they are absolutely timeless. So looking at the market right now, which one of these lessons do you think matters most?
Welcome to The Explainer. Today, we're taking a trip back in time, diving into a really fascinating first-hand account of just how radically the world of finance has changed over the last 50 years. We're heading to a place that, sure, is still called the City of London, but in reality, it was a completely different universe back then.
And look, this quote right here really says it all, doesn't it? This isn't a story about a few small tweaks here and there. Nope. We are talking about a total reinvention. A tale of two eras that are so different, they might as well be on different planets. So what exactly was so different? Well, to put it mildly, the contrasts are just night and day. Imagine a world where your career hinged on who you knew, not what you knew. Where massive deals were sealed, not over data terminals, but over long, alcohol-fueled lunches. That was the reality. You fast forward to today, and it's all about long hours at your desk in a world that's digital, data-driven, heavily regulated, and, well, a whole lot more impersonal. Okay, so to really get our heads around this, let's start by exploring the unique culture of that 1970s financial district. It was a place with its own set of customs and quirks that, honestly, feel like they're from a totally different century. I mean, this was a world with a set of unwritten rules that sound completely made up today.
Your job could literally hang on whether you knew the right people. You were judged on whether your shoes had laces or if your collar was properly starched. You had bankrupts still walking around in top hats. And get this, if you weren't an official member and got caught on the stock exchange floor, the punishment was public debagging. And yes, that is exactly what it sounds like. A pretty brutal and, I'm guessing, drafty form of public humiliation.
So you can just imagine how this culture of stiff tradition would clash, often spectacularly, with the actual urgent demands of the market. And a perfect example of this was the daily mad dash to submit the Treasury bill tender. Can you even imagine that? You're sprinting, literally running down a corridor to meet a critical noon deadline for your bank with millions of pounds on the line, and you are stopped dead in your tracks by a messenger wearing a pink morning suit, by the way, for breaking the sacred rule against running. It's just a perfect snapshot of that clash between urgency and old-world tradition.
And this story just perfectly sums up the whole, almost comical situation. So the directors wait till the last minute, forcing some poor young employee to physically race the paperwork over to the Bank of England. He gets stopped and told off for running, and then, and this is the best part, the tender gets rejected at the window, not because it was late, but because the paper was folded incorrectly. It's a system that cared more about rigid, pointless procedure than efficiency, a system that's now been totally replaced by electronics that are impersonal, but hey, at least they're flawless. So that whole world, with all its peculiar rules and slow-moving parts, well, it was about to get hit by a tidal wave. And that tidal wave was, of course, the information revolution, the single biggest agent of change you could possibly imagine. The tools of the trade basically went from the Stone Age to the Space Age seemingly overnight. Just try to picture it. Your main piece of tech was a calculator, powered from the wall, the size of a piece of paper. And then you put that up against the kinds of complex, automated financial models we can build in just a few minutes on a laptop today. The jump in what was even possible was just absolutely staggering.
And here's the really crucial takeaway from all this technology. The fundamental job of an investor got flipped completely on its head. In the old days, your job was to be a detective, right? An information hunter. You'd be out there trying to collect bits of information that nobody else had. Nowadays, the job is being an interpreter. Everyone has access to a tsunami of data. Your value now comes from being able to find the signal in all that noise.
So, with the tools changing and the data changing so radically, it's really no surprise that the role of the investor itself was completely redefined. It went from being this sort of quiet, low-profile job to the high-stakes profession that we all recognize today.
Okay, this next part is kind of mind-blown when you think about it. For a long, long time, the very idea of performance was totally different. The view was that just being able to pick shares and handle the buying and selling process was a valuable skill in itself. You know, it didn't really matter if you were any good at it. The whole concept of being judged against a market benchmark was only just starting to creep in.
You know, this really paints a picture of a profession that was still figuring itself out. Investment management wasn't some hotshot career path. For a lot of people, it was just a stepping stone to what they saw as more important jobs. The idea of beating the market, that wasn't even really a thing yet. And things like index funds were basically unheard of in the UK. Most firms didn't even do their own analysis. They just relied on what the brokers told them.
All right, now let's pull back the curtain a bit and look at how the game was actually played. Because let me tell you, some of the common practices back then would be completely unthinkable in today's tightly regulated world.
This is pretty much the Wild West. There were no strict rules about who got research and when, which meant there were massive opportunities for front-running. That is, trading ahead of information that you knew was about to move the market. Fund managers could even buy a stock, hold the trade open for days to see if it went up, and then decide which client's account to put it in. Think about that for a second. You could make your bet, wait to see if you won, and only then decide whose money was actually at risk. It was a system just begging to be abused.
And it wasn't just these, let's call them ethically flexible practices. The whole industry was incredibly fragmented. It wasn't one big interconnected machine like we see today. It was more like a collection of completely separate, locked rooms with vital information trapped inside each one.
You had the different desks, equity, fixed interest, US, Europe, and they were basically their own little kingdoms. The specialists in one area had little, if any, idea what their own colleagues were up to in another department. A UK fund manager might own a huge position in a British company and have absolutely zero clue about its biggest global competitor based in, say, Germany. Just no idea. That kind of blind spot is just impossible to imagine now. Okay, so we've gone from top hats and long lunches to algorithms and global data streams.
After this complete transformation, where do things stand today? What did we gain in all of this? And, maybe more importantly, did we lose anything along the way?
Well, one of the most important gains was a complete revolution in how we value companies. The thinking moved beyond simple metrics. The big question became, is this company actually earning a return that's higher than what it costs them to get money? In other words, is it creating real tangible value? This new pressure forced companies to become way more disciplined and focused on generating actual returns for their shareholders.
And the ripple effect of that change has been massive and, frankly, permanent. The quality of the average company you can invest in today is just higher. They're far more responsive to the people who own them, their shareholders, and the market as a whole is just way more efficient. The bottom line is, the average British company today is a much better, much more attractive investment than it was 50 years ago.
And this final thought really gets to the heart of it all. It's that classic double-edged sword of progress, isn't it? There is no doubt that the city today is a more professional, a more fair, and a more efficient meritocracy. But you have to wonder if in gaining all of that, some of the old character, the human relationships, and yeah, maybe even some of the fun got ironed out in the process.
And that really leaves us with a huge question, one that goes way beyond just the world of finance. As we optimize every single process and quantify every outcome in our relentless drive for efficiency, what are the human elements we risk leaving behind? It's the true and often uncounted cost of progress.
Do you ever wonder what the people managing billions of dollars are really thinking about the future of the market? Well, today we get a rare chance to peek behind that curtain. We're going to dive into the mind of legendary fund manager Anthony Bolton and explore 5 massive forces he sees reshaping, well, pretty much the entire world of investing. So let's break down what he sees coming our way.
All right, here's the game plan. We're going to start with this weird thing called a voluntary tax. Then we'll look at how private equity is actually making the stock market smaller. After that, we tackle the paradox of hedge funds. Then we get into shareholder activism, which can be a force for good or, well, not so good. And we'll finish up with what's next for financial regulation.
So first up, the voluntary tax. It sounds strange, I know, but according to Bolton, it's a deeply unfair advantage that's been hiding right out in the open in the UK market for years.
I mean, just think about that for a second. Imagine a tax where paying it is optional for some people. It just doesn't sound right, does it? Well, Bolton argues that when it comes to a specific tax on buying shares called stamp duty, that's exactly what's happening and has created this totally uneven playing field.
And this slide, wow, it really lays it all out. Over on the left, you've got the payers. These are your traditional big institutions, UK pension funds, insurance companies, the places managing most of our savings. They're paying the tax. But then look at the right, the non-payers. Hedge funds, a lot of overseas investors, even some savvy private investors. They can legally sidestep it, often by using complex financial tools like derivatives instead of just buying the stock outright.
So the bottom line for Bolton is that this is just a fundamentally unfair double standard. Simple as that. It actually punishes the very groups that are supposed to be safeguarding the public's retirement money, putting them at a disadvantage from the get-go. He predicts more and more of them will have to find ways around it, and his solution is pretty straightforward. Either get rid of the tax altogether or, just make the rules fair for everybody. Level the playing field.
Okay, let's move on to our second force, private equity. And this is a big one. It's not just about flashy buyouts you read about in the news. No, this is about a fundamental shift in the market itself, and the fact that it's actually shrinking right before our eyes.
The biggest issue Bolton points to isn't just about the number of companies on the stock market. It's about the people. He calls it a brain drain. We're talking about the best, the sharpest CEOs and finance directors. Many of them are leaving public companies behind for the incredible rewards they can get in the world of private equity.
And believe me, this has real-world consequences for you, for me, for anyone with a pension or a savings plan. Every time a company is taken private, that's one less investment available for the average person. The whole universe of options gets smaller. Over time, entire industries could just vanish from the public market. We lose access to these unique, interesting companies. And the hard truth is, there just aren't enough new companies going public to make up for the ones we're losing.
So what's a public company to do? Well, Bolton lays out a 2-step defense plan. First, he says they should actually take on more debt. See, private equity deals rely on piling on a ton of debt to finance the purchase. So if a company is already carrying a healthy amount, it becomes a much less attractive target. Second, and this one's a bit controversial, he says executive pay has to go up to compete. But, and this is the critical part, that pay absolutely must be tied to real, measurable commercial success. no free lunches. All right, on to our third force, the mysterious and often misunderstood world of hedge funds. They're known for charging crazy high fees and, as we're about to see, for failing a lot. So what's the paradox? Well, it turns out that despite all the risks, they might actually be providing a huge hidden value to the market as a whole.
It all really starts with the money. The classic 2 and 20 fee structure. What does that mean? It means a manager gets 2% of all the money they manage every single year, just for showing up. Plus, they get to keep a whopping 20% of any profits they make. Bolton calls this incentive a great draw. And it's so powerful that it pulls in everyone, from the absolute geniuses to, well, the folks who probably shouldn't be managing money.
But here's the brutal reality of that dream. Just look at these numbers from 2007. For every one hedge fund that opened its doors, 5 of them closed down. That's just incredible. The failure rate is astoundingly high, and Bolton fully expects that trend to continue. It's a tough, tough business.
So, here's the paradox. Why do they even exist if so many fail? Well, because they can add real value. An anonymous CEO told Bolton that meetings with hedge fund managers are just better. Why? Because they've done the work. They show up incredibly well-informed, and they ask the hard, insightful questions that other investors don't. They force company executives to be on their A game. In a way, they raise the bar for everyone.
And that actually brings us perfectly to our fourth force, shareholder activism. This is what happens when investors decide to stop just sitting on the sidelines and start using their power to demand changes. But as Bolton points out, this is a classic double-edged sword. It can be an amazing tool for good, or it can be pretty destructive. Now, Bolton is a huge believer in what he calls considered activism. He doesn't just think it's a good idea, he thinks it's a responsibility, especially for big, long-term investors. The thinking is, if you own a piece of a company and it's underperforming, you have a duty to get in there, get engaged, and push for the changes needed to create better results for everyone down the line.
But, of course, not all activism is the same. On one side, you have the good kind. It's focused on the long-term health of the business, it's based on having a real conversation, and it's usually backed by a pretty significant ownership stake. But on the other side, you've got a different kind of activist. One who might own just a tiny disruptive stake and push for short-term fixes that can actually end up weakening the company in the long run.
So, to protect that good kind of activism, Bolton says there are a few ground rules that are absolutely essential. First and foremost, you have to protect the one share, one vote principle. It's fundamental. He's also completely against any rules that would try to put a cap on how much influence a shareholder can have. And finally, he argues that investors have to be free to talk to each other, to share their ideas and coordinate their efforts.
And that brings us to our fifth and final force, regulation. Look, after the global financial crisis, it was painfully obvious the old rulebook just wasn't cutting it anymore. A whole new chapter had to be written for how we oversee the financial system, and the implications of that are absolutely massive.
This timeline here tells such a powerful story. Before 2004, there were actual legal limits on how much debt, how much leverage U.S. investment banks could pile on. But in 2004, those rules were relaxed. Bolton points to that specific moment as a key reason the crisis got so incredibly bad. And now, the expectation is that those stricter controls are coming back, and probably for good.
When you boil it all down, Bolton's argument is really about coordination. He says we absolutely need a global framework for this stuff. Having a bunch of different countries with competing regulators just creates gaps and loopholes for people to exploit. He points out that UK regulators have often been a step behind the curve, and its complicated three-part system might not even survive. And little things like having inconsistent bankruptcy rules from one country to the next put major financial centers like London in a really risky position.
You know, after dissecting all of these incredibly complex, high-stakes issues, Bolton ends on this surprisingly personal and, I think, really telling note. He says that after a 35-year career navigating all of this, the most important thing was that it was great fun. It's just a great reminder of the genuine passion and curiosity that drives people at the very top of this field.
And that really leaves us with the big question, doesn't it? We've looked at the battlegrounds, unfair taxes, a shrinking stock market, the hedge fund paradox, the two faces of activism, and a total rewrite of the regulatory rulebook. So as all these massive forces keep grinding against each other and reshaping our financial world, where do you think the next great opportunities are going to be found?
Imagine getting a 20% return on your investments every single year for nearly 3 decades. I mean, that's not some fantasy number. That was the actual reality for Anthony Bolton, one of the UK's most legendary fund managers. So the big question is, how on earth did he pull that off? Well, that's what we're going to do right now. We're going to decode his entire strategy, boiling down his timeless wisdom into a clear blueprint that, hopefully, you can use.
You know, this quote just nails it, doesn't it? It perfectly captures this central challenge, right? This tension that every investor faces. Having the guts to stick with your own research, but also having the humility to actually listen to what the market is trying to tell you. It's a real tightrope walk, and honestly, his whole philosophy is about finding that sweet spot.
So let's dive in. We've broken down his approach into 4, let's call them foundational pillars. We're going to start with understanding the business itself. Then we'll jump to who's running it and what it's worth. After that, we'll get into the psychology of the market. And finally, wrap it all up with how you manage your portfolio and, just as critical, yourself.
All right, so Pillar 1. This is all about getting back to absolute basics. Bolton's first rule was to completely ignore the ticker symbol and all that daily price noise. He really wanted people to see a stock for what it actually is, a tiny piece of a real, living, breathing business.
So before you even think about looking at a balance sheet or a PE ratio, you've got to ask yourself this one simple but massive question. Is this company built to last? Does it have a genuine competitive advantage, a moat, as they call it, that's going to protect it? And if you can't look at it and say, yes, absolutely, then for Bolton, it's simple. You just walk away.
Okay, here's another one of his big litmus tests. Can you explain what this company actually does, how it makes money in just a couple of simple sentences? If you can't, well, that complexity, that's a huge red flag for him. For Bolton, simplicity isn't dumbing it down. It's the sign of a really strong, focused company.
Okay, now we're getting to the numbers. But Bolton was really specific about which numbers mattered. See, he was super wary of reported earnings because, let's be honest, those can be played with, right? Accounting tricks can make them look like anything. He zeroed in on cold, hard cash. And why is that? Simple. Cash flow tells you the actual story of a company's health.
And this, right here, this was his ultimate rule of thumb. Whenever the story from a company starts to get a little fuzzy, or the promises from management sound just a bit too good to be true, just follow the cash. The cash flow statement cuts through all of that corporate jargon. Like Bolton always said, cash doesn't lie.
All right, that brings us right to pillar number 2, management and valuation. So once you're feeling good about the business itself, the next move is to look at who's actually running the show and this is a big one, figure out if you're paying a fair price.
Man, Bolton was just laser focused on character. His belief was simple. You only, and I mean only, invest with managers you trust. Full stop. If there's even a shadow of a doubt in your mind about their honesty or if they're even good at their job, his advice, just walk away. It's not worth it.
Now this was totally non-negotiable for Bolton. You have to be able to spell out, and he really preferred you write it down, exactly why you own a particular stock. What's your thesis? What do you think the market is getting wrong? That thesis, that's your anchor when the markets get choppy. And it's not a one-and-done thing. You've got to be testing that thesis constantly. If the facts change and it's broken, you have to be disciplined and sell.
And to make sure he was disciplined, Bolton had this really holistic process. Before you'd even think about buying a single share, any idea had to go through this 6-point checklist. It's just a really systematic way to make sure you've covered all your bases, from the quality of the business all the way to the squiggly lines on a chart.
So let's talk valuation. How did he actually think about it? He had a few really clear, hard and fast rules. Rule number 1, don't get obsessed with just one metric like the PE ratio. It's a classic trap. He'd always zoom out and ask, okay, how does this company's price today stack up against its own history, say over the last 20 years? Buying a great company when it's historically cheap, that was his secret to building in a margin of safety. All right, pillar 3. Now we're moving out of the company's financials and into the wild, crazy, and let's face it, often irrational world of the stock market itself. Yeah, this is where Bolton really dug into human psychology, the fear and greed that can just throw prices all over the place in the short term.
Bolton was a massive fan of this famous metaphor from his hero, Benjamin Graham.
In the short term, the market's just a popularity contest, a voting machine. It's all about what's hot and what's not. But over the long haul, it becomes a weighing machine, where the real, fundamental value of a business eventually wins out. The whole trick, the real key for an investor, is to have the patience to just focus on that weighing machine, even when that voting machine is going completely haywire.
And get this, he didn't just sit around and wait for good deals. No, he was actively hunting for these moments of extreme emotion in the market. When the headlines were screaming, sell, 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 and everyone was panicking, that's when he was buying. And when everyone was getting greedy and euphoric, he was getting cautious. These huge waves of emotion, for him, that was the signal. That was the time to do the exact opposite of what everyone else was doing.
I mean, being a contrarian, it's just baked into the DNA of his success. He was famous for buying these recovery stocks, basically solid companies that were just deeply unpopular. Just think about it. It's like buying an airline stock in late 2020 when no one was flying, or buying a big oil company when everyone was saying fossil fuels were dead. He just got this fundamental truth. A lot of the time, the absolute best investments are the ones that feel the most uncomfortable, even a little scary to actually pull the trigger on.
Okay, pillar 4. This is where the rubber really meets the road. Because look, it's not enough just to find good companies. You have to actually build a portfolio, manage your positions, and maybe most importantly, manage yourself, manage your own emotions, and keep risk in check.
So when it came to actually managing the portfolio, he had a few golden rules. First off, let your conviction decide your position size. Simple, right? Your best ideas should get the most money. Second, you cannot get emotionally attached to a stock. And finally, you have to accept that you are going to make mistakes. It's going to happen. For Bolton, winning wasn't about being perfect. It's all about making sure that when you're right big. Big enough to more than cover the times when you're wrong.
And this next one, this is a really powerful lesson. Probably one he learned the hard way. Bolton is crystal clear on this. The biggest, most painful mistakes, the ones that can just totally wipe you out, they almost always involve companies with bad balance sheets, companies that are just drowning in debt. A weak balance sheet gives you zero room for error.
He also had this huge warning about another major risk: getting sucked into those speculative bubbles. You know, chasing those really hot, overvalued stocks. He called it a dangerous game of pass the parcel. It's like musical chairs, really. Your only strategy is hoping you can dump it on someone else before the music stops. And trust me, that is not a game you want to be playing.
You know, selling a stock, it can be even harder than buying one. So to keep himself disciplined, Bolton used this really clear 3-part framework. He would only sell if, 1, his original reason for buying was just flat out wrong, 2, the stock had hit his price target and was now fully valued, or 3, he found something that was just a way better opportunity. He was convinced that if you're selling for any other reason, especially if you're just panicking, you're probably making a mistake. So let's wrap this all up with the one single question that I think captures the entire Bolton blueprint. What is the market assuming right now, and what is it completely ignoring? Just asking yourself this question forces you to think like a contrarian. It makes you look past the noise, past the headlines, and start digging for the value that everybody else is just walking right past. And that right there, according to the man himself, is the key. It's how you go from just being in the market to actually winning at the market.
All right, welcome. You know, we're all looking for an edge, aren't we? That little piece of secret knowledge that kind of separates the greats from everyone else. Well, today, we're not just getting a piece of it, we are getting the entire blueprint. We're about to unlock the personal library of some of the world's greatest investing minds. So, just imagine this for a second. What if you could find the exact sources, the very books and articles that shaped a master investor? I'm not talking about their latest stock picks. I'm talking about the very foundation of their thinking. What would that kind of insight be worth to you? It's a pretty powerful thought, isn't it? And the answer? Well, it might actually surprise you. The real secret isn't some hot stock tip you get from a guy who knows a guy. No, it's something way, way more valuable. And it's been hiding in plain sight this whole time, usually at the back of a book. It's a bibliography. Now, I know what you're thinking. A bibliography? That sounds academic. A little dry, right? But I want you to completely reframe that in your mind. Don't think of it as a boring list. Think of it as an intellectual roadmap. It's a treasure map that lets you trace the exact path of an expert's thoughts. It shows you not just what they know, but how they came to know it. And today, we are absolutely following that map. So, our journey has to begin with the patriarch, the man who literally wrote the book, or, well, books, on modern investing. This is the foundation that pretty much everything else is built on.
Let's dive in and talk about the dean himself, the one and only Benjamin Graham. Now, take a look at the dates on these books. 1934, 1949. These are not some flash-in-the-pan bestsellers we're talking about. These are time-tested foundational classics. Security analysis is, well, it's the exhaustive, heavy-duty textbook. But The Intelligent Investor, that's the one Warren Buffett himself calls, and I quote, by far the best book on investing ever written. These two works are basically the Old and New Testament of this entire philosophy. So, what was this big revolutionary idea that Graham came up with? It all boils down to a concept called value investing. And it's so simple, it's brilliant. You do the work to figure out what a business is actually worth, its real intrinsic value, and then you just wait. You only buy it when the market offers it to you for a lot less. That gap, that discount between the price and the value, that is your margin of safety. Think of it as your intellectual shock absorber. It protects you from bad luck, a changing world, and even your own dumb mistakes. And this quote just nails the mindset, doesn't it? It's not about fancy algorithms or complex financial models. It's about your temperament. Graham taught that you should think of the market as your business partner, Mr. Market. And he's a manic depressive. Some days he's euphoric and offers to buy your shares for way more than they're worth. That's when you sell to him. And other days he's terrified and offers to sell you his shares for pennies on the dollar, and that's when you buy. So simple, but man, so hard to do in practice. Of course, every great teacher has a star student, right? And in this story, that student went on to become, well, arguably the most successful investor in all of history. So let's move on to the disciple and see how these ideas evolved. We're talking, of course, about Warren Buffett. You see, Buffett started out as a pure Graham guy. He was buying these statistically cheap stocks, what he called cigar butt stocks. You know, there's one last puff left in them, and it's free. But then, with a lot of influence from his partner Charlie Munger, his thinking evolved. He had this huge realization that it was far better to buy a truly wonderful company at a fair price than a fair company at a wonderful price. He kept that core margin of safety idea, but he started applying it to the quality of the business, not just its price tag. That was a game-changing leap forward. And what's just so remarkable is the consistency. I mean, look at this. These are entries from the bibliography that span decades. Whether he's writing in his legendary chairman's letters in '83, or again in '96, or in some article, the core message never, ever wavers. He's been teaching the same fundamental ideas about thinking like a business owner for more than 50 years. In this quote, this one just says it all. This isn't about renting stocks. It's not about trading little blips on a screen. It's about owning businesses. When you buy a piece of a great company, you shouldn't be thinking about selling it next week or next quarter. You're a partner in that business. And that right there is a huge mental shift from short-term speculation to true long-term ownership. But you know, Graham and Buffett aren't the only voices in this choir. That would be too simple. Our bibliography shows us there's a whole group of brilliant minds who got ahead by intentionally thinking differently from the crowd. So welcome to what I like to call the Contrarian chorus. Okay, let's look at two really fascinating examples of this kind of thinking. On one hand, you've got the world-famous economist John Maynard Keynes. Back in 1936, he described the market like a beauty contest. But here's the twist. To win, you don't pick the contestant you find the most beautiful. You have to pick the one you think the other judges are going to find most beautiful. It's all about thinking on that next level. And then you have Sir John Templeton. His rule was a lot simpler, but maybe even more powerful. Find the point of absolute, total, maximum pessimism. When the news is awful and everyone is selling in a panic, that's when you buy with both hands. This quote from Templeton is basically the ultimate contrarian mantra. It's really the core of what Graham and Buffett practice, but just stated in its most extreme, potent form. This is a guy who made a fortune buying up European stocks right as World War II was breaking out. Can you imagine the courage that took? He did it because that was the point of maximum pessimism. It's all about having the guts to act when everyone else is completely paralyzed by fear. So, okay, we've walked this incredible intellectual path of the masters. We've seen the foundation, we've seen how it evolved, and we've heard from the contrarians. So now we get to the most important part. How do we take all this wisdom and make it our own? Well, it's time to start building your own bookshelf. I'm telling you, this bibliography is an absolute goldmine. Beyond the people we've already talked about, you're going to discover other giants, and they each offer a totally unique way of looking at the world. You've got Peter Lynch, who's famous for championing the idea of investing in what you already know. He empowers you by saying, hey, your everyday experience can give you an edge over Wall Street.
Then there's Bill Miller, famous for his amazing market letters that just blew up conventional wisdom. You'll find the philosopher of randomness himself, Nassim Taleb, whose work it'll force you to rethink everything you thought you knew about luck. And of course, you can't forget Charlie Munger, Buffett's partner, the master of using mental models from all different fields to make better decisions. Each one of these guys adds another critical layer to your understanding.
So let's be perfectly clear about this. What we've uncovered here, this is not just a reading list. It's a complete curriculum. It's a self-directed masterclass in rational thinking, in business analysis, in market psychology. And it's all curated by the very people who perfected the craft. This is the kind of education you just can't get in a classroom. Okay, so how do you even start? It can seem a little overwhelming, but here's a really simple game plan. Step 1, you have to start with the foundation. You must read Graham's The Intelligent Investor. Seriously, it's non-negotiable. Step 2, learn from the master practitioner. Go to the Berkshire Hathaway website and start reading Buffett's annual letters to shareholders. They're free and they're priceless. Then, step 3, once you've got that base, start to widen your perspective. Pick one of the contrarians, maybe Lynch or Taleb or Munger, and just dive into a completely different way of seeing the world.
The books and letters on this list, they built the great fortunes and the great intellects of the last 100 years. They teach these timeless principles like prudence, patience, and the courage to think for yourself. But, the world is always changing. So the final question isn't just about what's on their reading list. It's about what's going to be on yours. What are you reading to prepare for the challenges and the opportunities of today and of tomorrow? The legends built their library. Now it's your turn to start building your own.